Good morning.
I don't know, but I haven't called it.
Ready to go. Call the meeting in order. First, you notice that we are video recorded. Second, roll call.
Mark Nodig.
Here.
Carl England.
Here.
Jack Prothrow.
Here.
Terry Cohey.
Here.
Joan Satry.
Here.
Diane Fladmo.
Here.
Maggie Peterson.
Here.
Jeff Greenfield.
Here.
Jim Edwards.
Here.
Senator Sales. And Representative Hamilton.
Okay, thank you. Last time for public comment. Any member of the public who wishes to speak on a matter within the jurisdiction of the board but not on this agenda?
I have something.
Are you a member of the public?
Well, sort of.
We're hereby deemed such.
Is that a good thing?
Yeah.
So, Jerry asked that we not make a big deal of the fact that this is the last day of our last board meeting. But we couldn't help ourselves. And besides that, now we can, Louise started it. So, if you're going to get mad at anyone, please get mad at her. I don't, what Louise said yesterday, we couldn't agree more. I mean, the words that she used were respect, hard worker, competent, style, and grace. Those are all things that we all feel. It's been our great pleasure to work with you. It's been our great pleasure to watch you as you have fulfilled your duties and then some for the benefit of the board and the retirees and the people of the state of Montana. We will miss you very much, but you have deserved your retirement. We wish you the very best in it, and without making a big deal about it, we just wanted What's that?
Too late for that.
Too late for what?
Not making.
Well, it's not a big but if I can get rid of that. For you, from us? No, thank you.
I will just say a few words. I don't have prepared remarks, but it has also been a pleasure working with the board, with all of you. You're very talented and dedicated members. I've worked with some of you for many years, so thank you for that. And also to the staff, we've got a talented staff here, and it's been a pleasure to work for all of you. So thank you.
Thank you. Best wishes as well. You'll be missed. Mainstay since I've been here. A lot of changes going on. One of the negative ones is negative for us, positive. Okay, the next on the agenda is ER systems. You typically do this jointly, exactly what after that.
What's that?
You both can appear at the same time?
Sure.
Okay. Yeah. Welcome.
Thank you.
You're on the agenda first, whatever it is.
All right, thank you. Good morning, Mr. Chair, members of the board. For the record, my name is Sean Brown. I'm the Executive Director of TRS, and I'm here today to present the results of the July 1st, 2018 actuarial evaluation. We're statutorily required to do this under 1920-215, where we're supposed to annually present the results of the evaluation and also brief the board on any benefit changes that we will be proposing that could affect trust fund obligations. So the good news is we're not proposing any major changes this next session that would affect trust fund obligations, and hopefully no one else does either. But I can't guarantee that. So I believe you all have a copy of the presentation in your packets. It looks like everyone's turned to page 2, which is the basic retirement funding equation where you have contributions plus investment income should equal benefits and expenses. Now, if one side outweighs the other, the left side, if you have more contributions and investment income, you build a surplus, or you use that surplus to pay down any unfunded liability you have. If the right side of the equation is heavier and you have more benefits paid and expenses, then you run a larger deficit or you add to the unfunded liability. So that's the basic equation. In a perfect world, when the last member of TRS were to pass away, we would have exactly $0. This contributions plus investment income would equal benefits paid plus expenses. Okay, on page 3 of the presentation, there's a little information there about who participates in TRS. TRS is the retirement system for teachers, administrators, specialists, and others employed in a teaching or educational capacity by a public school district, a state agency, county, community college, the university system, or an educational co-op. And so currently we have just over 19,000 active members in TRS. We have a little over 15,000 inactive members, which means they have money on account with TRS, but they're not currently teaching. That doesn't mean they may not come back in the future. All of those members would be entitled to withdraw their funds, or if they qualify to do the vesting, they would be entitled to a monthly benefit at some point in the future. We have almost 16,000 retirees and benefit recipients, and we serve 365 employers in the state of Montana.
Sean, do you work with a percentage of inactive members? Do you have a number on the percentage of inactive members who eventually draw, or percentage who just go away and their money?
So, Mr. Chair and Carl, eventually nearly all of them take them. There are a very small number, and we haven't written off anyone since I've been there 5 years.
Okay.
But eventually, if no one ever makes claim to the funds, then they just remain with TRS. But it's a really small.
That's a very small.
Yeah. All right. So on page 4 of your report, there's some general comments about the valuation. On a market basis, our rate of return was 8.82% for fiscal year 18 versus the 7.75% expected rate of return, which is 1.07% greater than expected. However, due to actuarial smoothing, where we smooth essentially, it's not a mathematical average. It's really based on the dollars. It's not a simple average, but we do a 4-year smoothing, and due to that, because we dropped off a really high year, I think it was about 17%, and we replaced it with an 8.82%, our actuarial rate of return was 6.85%, which is less than the actuarial assumption for fiscal year 18. So we did incur an actuarial loss this last year. The market value of assets were $54 million more than the actuarial value of assets. That unrecognized gain will be recognized over the next 3 years. The funded ratio of TRS decreased from 70.49% to 68.19%, and the amortization period increased from 22 to 31 years. And most of that is due to what I'm going to explain on the next page, which is in May, the TRS board met, and we were due to do our experience study. Every 4 years, we do an experience study, which looks at the actual experience of the system over the previous 5 years. And the actuary will make recommendations based on that actual experience plus updated projections for future. And there were several assumption changes that took place. And so our increase from 22 to 31 years, 6 of those years were expected. We knew that was going to happen based on the assumption changes we adopted last May. The additional 3 years was a result of the actual rate of return being slightly less than our assumed rate of return.
Well, pretty basic, but briefly discuss the difference between the actuarial return and the market return.
Sure. You know what, I think the easiest way to look at that is, switch you to the right page. Okay, on page 9 of your report, you can see at the bottom there's market rate of return. So that's the actual market rate of return for each of those years going back to 2007. And then the bottom line is actuarial rate of return. And I alluded to it, but the actual rate of return is smoothed over a 4-year period. So if you have an actual gain this year, you only recognize 25% of that gain this year, and the remaining 75% is realized over the following 3 years. And it's not, if you look at those numbers, it's not a simple mathematical average. It's based on dollars, so that's why it's close, relatively close, but it's not a simple average. Does that answer your question?
It does, thank you.
All right, so on page 5, there's some information about the changes since our last evaluation. Like I said, we did just conduct an experience study, and the following assumptions and methods were updated. Our price inflation was reduced from 3.25% to 2.5%. The investment rate of return assumption was reduced from 7.75% to 7.50%. Wage growth was reduced from 4% to 3.25%. We updated our pre- and post-retirement mortality tables. We updated our termination rates, retirement rates, and rates of salary increases. And our payroll growth assumption was reduced from 4% to 3.25%. As a result of that, along with the actuarial loss for investment return this year, our amortization period increased from 22 to 31 years, and our unfunded actuarial accrued liability increased by $206 million. Now, this isn't, dire.
Isn't 30 the magic number that if you're over 30, you're not exactly being here that you're not?
Yes, that's a great question. So the industry standard.
Question again?
I thought 30 was the magic number. You wanted to be under 30, and we just went over 30.
At or under 30, you'd have to amortize within 30 years,
Yeah.
correct?
Right, so the constitutional requirement is that the state shall fund the systems on an actuarial sound basis. And an actuarial sound basis, the industry standard, there isn't, like something in stone, but the industry standard is 30 years or less. We did bump over 30 this year. However, the increase in contributions would only be 0.4% of payroll. It's $330,000. We're expected, if we went from 22 to 31 and we were expected to get worse next year, we would be bringing a funding bill. But we're expected to decrease each year thereafter, so by the time the legislative session was over, we should be at 30 anyway, so we're not opposing any funding bill this session.
So that decrease is going to be as a result of that smoothing part of it?
Yes and no. I mean, so if all of the assumptions are met perfectly, from here on out, we would decrease our amortization period by 1 year each year until we get to 2048, I think it is now. If they're not, if investment returns are higher than expected, then and we've had this happen in recent years. We, instead of dropping 1 year off the amortization period, we're dropping 2, sometimes 3 years, or if investment earnings are less than expected, we could add to it. So it doesn't take very much. When you're right up against the line at 30, you could have a 7% return next year, and we could be over, we could be over 31 again, we could be 33, 34. We're right there on the line. It's very sensitive when you're right up against it. However, I think, considering where we were back in 2013, 2012, we're on very solid footing compared to where we were, and with much more conservative assumptions. These are all more conservative assumptions. Okay, so moving on to page 6, there's some bar graphs that show our active and retired membership. Again, those are the same numbers we looked at earlier. On the active side, we had almost a 2% increase in active members for fiscal year 18. On the retired side, we had a 2.4% increase. And 11 years ago, we had 0.6 retirees per active member, and today we have 0.8 retirees per active member. And that's mainly for information purposes. There's nothing wrong in a mature system with that number being 1-to-1, even 1.2-to-1. It's expected over time. I mean, this is all projected by the actuaries. They know, they can project out how many retirees we're going to have each year versus how long they're all expected to live. This is nothing we didn't know was coming, but that's going to continue to creep up. Okay, on page 7, there's a slide that shows the average salary and benefits. This is for full-time employees of TRS, and you can see that our full-time salaries increased by 0.7% for fiscal year 18, and the average benefits increased by 2.1% for fiscal year 18. Again, that's excluding any part-time members, so this is only full-time members of TRS. And that full-time salary on average was $54,222, and the benefits on average were $23,096. So not some very generous, very expensive plan. Okay, on page 8, again, this is full-time payroll, so this is for full-time members. You can see it's right at $700 million. Our actual valuation, total compensation was at $830 million. So this is only full-time members. But this represents what we have in payroll versus what we have in benefits. It's nice to see those lines separated. There's not really any kind of perfect correlation here. I think if they were to cross over one another, I would start getting a little worried for sure, but it's nice to see that they're trending the right way. Speaking of that. Okay, on page 9, this illustrates our market value of assets versus our actuarial value. If you remember last year when our market value and our actuarial value were almost exactly the same, that's a coincidence more than anything. It's not going to happen very often. This year, actually, our market value is higher than our actuarial value. And you can see, we already talked a little bit about the effect of smoothing. Last year when I was here, the 4 years used on a market rate that made up the actual rate of return were 17.1%, a 4.6%, a 2.1, and 11.9. This year we dropped off that 17.1. So we're looking at a 4.6, a 2.1, an 11.9, and an 8.8, and that's why we ended up slightly under the 7.75% assumption for this year. Now, you've heard me, if you've been, I know it's hard, because it's part of actuarial things, and you're all wanting to fall asleep, but I've been mentioning 7.75 in some instances and 7.50 in other instances. Our new assumption is 7.5. But when you adopt those, the actuary doesn't use those for the year you're in at that time. So in May, we were still 7.75 through July 1st, and then going forward at 7.50. So that's why everything is based on the difference between 7.75 and whatever the actual rate of return, which was 6.8%, 6.9%. 6.85%. That's why that difference is, it's more than, and I really quizzed them about that. So why are we not using 7.5? It would be less of an actuarial loss. And they said that's not appropriate. For the year you were in, you were still using 7.75. So in some respects, and I'll just mention right now, if we were to use the market rate of return, we would amortize in 29 years. I mean, so that additional $50 million, that makes up all the difference plus now. We drop from 31 to 29. Okay, on page 10, this slide is one that we started using a few years ago, and it just shows the relationship between the actuarial value of assets and the unfunded liability of the system. And you can see back in 2013, when the legislative changes were implemented, our value of assets have steadily increased year over year, each year thereafter. And our unfunded liability had decreased year over year, each year thereafter, until we got to this year, this 2018, and that is really attributable to the assumption changes. But those are more conservative assumptions. Page 11 is a snapshot of our cash flow history. You can see, obviously, the big lever here is really investment income. if investment income is higher than expected, our cash flow looks really good. If it's lower than expected, our cash flow doesn't look so good. So like in 2008, 2009, where we had those big losses, our cash flow, we were eating into the corpus big time for those years.
Sean, just to clarify, you're using income as both income and capital gains, right?
Yes. All right, and then page 12 of the presentation is just the summary. 2018 is in the right side column, and you can just see, how things have changed from 2017 to 2018. Our normal costs went up slightly, and that's due to the adoption of the new retirement rate or mortality tables, meaning we can have graphic changes there.
So Sean, how old does an average person live to enough to make? I'm a little worried about it.
That's a good question. I actually have thought of that a lot. I never actually asked the actuary. I don't think I really want to know the answer.
Not as long as women.
We load into our system the tables, and they stretch. I think most of them are around 80, 85, but we're averaging both males and females. So
The older you are, the better chance you have to live longer, by and large.
Okay.
I really don't know the
Yeah, if you hit 65, the prospects, I think if you're 65 and a man, your chances now of making it to 84 are very good. And I don't remember a woman probably a little bit longer.
If you're a teacher, then. Banker is a whole different thing.
Fishermen, too.
Fishermen, they go with it.
So, on page 12 there, I'll wrap up and just, you can see our actuarial value assets did go up from 3.9 billion to almost 4.1 billion. Our unfunded accrued liability, like I said earlier, went up by 200. Our funded ratio decreased and our amortization period increased. However, we are using more conservative assumptions at this point, and I think we're far better off than we were 5 or 6 years ago.
Sean, tell me on the top of the definitions on the top of the things on the top of the chart on page 12. So the normal cost rate is?
So the normal cost, that is the percentage of payroll that it would take to cover a new member, a member of the system today.
Okay.
On average. So you have tier 1 members and tier 2 members.
Right.
Tier 2 members are cheaper for the
Right.
system than tier 1. So that's a blended rate of what it takes in payroll to pay for that member today.
Okay.
Now,
And that number went up from 17 to 18 because that member's going to live longer.
for the most part, yes. As long with some of the other assumptions.
Right. They're not going to make, they're not going to be as high increases in annual.
Yeah, there's
Annual
salaries
raises
and
and all that.
increases
Okay.
as much as expected.
Okay, and then the member rate is the rate set by statute.
That's the member's contribution rate, so that 9.96 minus the member contribution rate of 8.15 leaves 1.81% to cover the cost of that member. So that's what the employer normal cost rate is. So of the employer contributions then, 1.81% goes to cover that normal rate. Then the remaining, after you take administrative expenses out, the remaining 9.29% of employer contribution goes to pay down the unfunded liability. So almost all of the employer contributions are going to pay down our unfunded liability.
And the employer's normal cost rate is, by statute, fluctuates?
So it until 2024, since July 1 of 2014 has increased 0.1% each year through 2024.
Oh, okay.
As part of the fix in House Bill 377.
Okay.
So yes, it was 11.36 last year. In fiscal year 18, it was 11.46. This current year, fiscal year 19, it's 11.56.
So the employer normal cost rate is just simply the member rate, is the normal rate minus the member rate?
Right.
Right, okay. That doesn't reflect, okay, I got it.
And then the UAL is what?
The unfunded accrued, the actuarial unfunded accrued liability.
Right.
Yep. final slide there on page 13 is just the picture representation of when TRS will be 100% funded, if all the assumptions are.
And why does it go up for a few years, just like it?
They always do that, according to the actuary, which to me, I don't know if I completely buy in. If everything worked exactly perfectly, it will increase a little bit over time, over the next year or two, and then it'll decrease. In all the 5 years I've been here, it's either we've gained more than 1 year. I mean, usually we gained, the last several years, we've gained 2 years at least on the amortization period. But I guess when you project it out, if everything were to hit perfectly, according to the assumptions, our liability would increase a little bit, and then we really catch up over the long term.
Have you ever asked for an explanation of why? I don't understand from just a conceptual standpoint why it is.
I think it's the interest on the liability.
Oh, is that what
is what it is, yeah.
Okay.
Yeah. So your actual dollar amount is going to continue to grow. That UAL, unfunded actual accrued liability, is going to grow until about 2030 essentially, and then we're really going to start eating into it. But in the meantime, our contributions are increasing each year. Our investment income is expected to increase each year because we're expecting 7.5% now. So when you get 1 year in the books, the next year it's 7.5% on a higher number, right? So we have more coming in that outweighs that difference.
Just a quick question. I've forgotten the details of the bill that passed. So if I figured it out right, by 2024, employers will pay 12%. Is that right? But employees' rate remains the same?
So by 2024, so the first year it went into effect it went from 9.85% in 2013 to 10.85. So it was 1% right out of the gate, and then plus an additional 0.1 for 10 years. So it ends up at 11.85% for employers.
Oh.
The employee member contribution remains at 8.15.
Okay, thank you.
Sean, overall, what are your concerns? Not the actuary concerns, but your concerns as the administrator that would reflect on what we're doing here.
That would reflect on the Board of Investments.
Or just in general, your main concern.
I there's no doubt that we are subject to the whims of the market. I mean, I think the board puts a lot of work into, now Director Villa and his staff, Joe Cullen, the Chief Investment Officer, they put a lot of work into trying to figure out the best allocation that will give us the best chance to meet our expectation without taking too much risk. I mean, I think there's no question there's a trade-off, risk versus reward. And we obviously can't just be in completely low-risk investments, or we'll never achieve what we're trying to achieve. As far as it being a terrible concern, I don't know that it is. I mean, it's part of the business. It's a defined benefit plans, especially mature ones, and the way you can look at the legislative history of TRS. It was set up in a manner that is trying to make it as affordable, provide the best benefit as affordable as possible for everyone concerned, which includes the state, it includes the employers, and it includes the members. If we were to go super conservative on our assumptions and say that we only expected to bring in 4% a year, that would result in a hefty increase in employer, employee, and additional state contributions. And I don't think there's a lot of desire to do that. So just what's going to happen in the market is probably the biggest unknown. I think if you look at historical trends, I mean, our inception to date number, I believe, is around 7.8%.
7.78.
Yeah, 7.78%. So over the long term, that goes back to 94, over the long term, we've been able to achieve that assumption, and we've actually reduced our assumption based on more recent information we've got from you all, in part, and your consultants. I mean, when we do that experience study, our actuaries work with not just your consultants, they also work with outside consultants when they try to project what do we expect to bring in over the next 8 years, and that's how we landed at that 7.5%. it's not set in stone, we'll look at it again 4 years from now.
Sean, just, could you explain a little bit about the changes to benefits that occurred in the House Bill 377 that might affect future costs? For instance, the variable GABA, years, multiplier.
Sure. So I mentioned earlier, the Tier 2 members are cheaper for the system than Tier 1, and there's a couple of reasons for that. First of all, anyone hired after July 1, 2013, we're going to use their 5 highest years to calculate their average final compensation instead of 3. On Tier 1, we use 3. We bumped out the normal retirement age for both Tier 1 and Tier 2 is 60, but if you're Tier 2, you have to be, you can retire at age 60 with 5 years or more service credit. Tier 1 used to be able to retire with 25 years of service credit at any age. Under Tier 2, you have to have 30 years of service credit in order to retire and you have to be age 55. Or if you make 30 years and age 60, you actually qualify for a higher multiplier. Then on the other end of the spectrum, once they're retired members of the system, House Bill 377 attempted to adjust the guaranteed annual benefit adjustment for all members of TRS, and that ended up in court. And thankfully, the court found that the state could not do that. So anyone that was Tier 1 member, their guaranteed annual benefit adjustment remained at 1.5% due to the court decision. But all Tier 2 members, they have a variable rate, cost of living increase rate, and it's at a bottom of 0.5% and at a maximum of 1.5%. And so for current Tier 2 members, and we already have some that are actually retired, and we had the first one receive GABA this last year, they're at 0.5%. And Carl's making a face at me, how can that be? Well, if you have a Tier 1 member that withdrew their contributions and they come back to TRS after July 1 of 2013, they come back as a Tier 2 member. So we've had some of those that, based on age and service, they were vested and likely over age 60 is how they got there. Not very often does someone have 20 years of service that they withdraw and then try to redeposit. But we've actually had several of them retire, and they've been retired now for over 36 months as of January 1, so they get that 0.5% gap. So they are cheaper for the system.
That was not a good decision.
Mr. Chair, I just wanted to respond to Jack's question about what you might worry about in the DB plan. Since we did the last asset liability study for you, we've developed an extensive battery of stress tests looking forward. And they're all targeted at exactly your question. What are the circumstances in which a DB plan would suffer more stress over the next 5 to 10 years than would be true under the assumptions, which is the right thing to do. The assumptions are the core projection device that we would use and that their actuary uses as well. What we're finding in these asset liability studies is one of the worst potential futures is not something like the great financial crisis where we have a great big drop and then a V recovery. It's the duration of the gap between actual returns to the portfolio and the accruing of additional liabilities, which people come to work every day and you invest new liabilities, those don't change. And so in some respects, and I find myself almost joking saying this, the great financial crisis was not the worst thing that could have happened to DB plans because the recovery was so sharp and relatively quick by market historical standards. Compare it to its most likely counterpart, which was the Great Depression, where that extended on for almost a decade. So when we're doing asset liability studies now, this is a scenario that we're spending a lot of attention on to try to get a sense of what is the downside to things like the UAL and contribution rates and funding ratios and so on. So at some point, should you ever ask us to do that, you'll see something different than you've seen in your historical asset liability studies from us. And it may target exactly the question you asked, Jack.
There we go, Sean, now you know exactly what you want.
already had the opportunity to work with Director Noah in his new role here at the Board of Investments on a couple different issues. The communication lines are open, and we're looking forward to working together with him and the rest of the staff this legislative session.
Thank you.
You bet.
Thank you for the opportunity, Chairman, and members of the board, Dory Schwinden, on behalf of the retirement systems at Empera. I also want to compliment and thank Ms. Burton for her years of service. We've gotten wonderful cooperation and help from her over the time, so I want to recognize her service and thank her for that. I feel fortunate that Director Graham has gone first. I often have to lead these, and in legislative situations I do as well, but Sean does such a great job of answering those tough questions that if it's all right with you, I'll speed through these slides because they're very similar to what Director Graham has described with teachers. The first slide is again the fundamental retirement funding equation, where contributions and investments should equal benefits plus expenses. And the contributions, of course, are set by the legislature. They're statutory. Investments vary, performance-based. Benefits are within the plan provisions, and our expenses have been stable at 0.26% of payroll. Again, Director Graham mentioned that the requirements for the annual valuation are found in 19.2405, but the evaluation itself is a snapshot in time. It provides a baseline for evaluating the sufficiency of contributions and the funded status of any pension system. There are two steps to that process. One is the collection of the data to make the economic assumptions and project future benefits. And second, to determine the present value of the assets and liabilities, to calculate what the employer contribution should be. Slide 2 speaks to our participants in the Empera programs. We administer 10 distinct pension plans, 8 DB plans, defined benefit plans, 1 defined contribution plan, and a 457 deferred compensation plan. The record keeper for both the DC and 457 plan is Empower Retirement, formerly known as Great West. Our participants are state and local government, certain employees of the university system and school districts, with almost 70,000 members and retirees. Our active, retirees, and inactives are listed below. We receive covered payroll reports from 564 public employers and 235 volunteer fire departments under the Volunteer Firefighters Compensation Act. Page 4 are again comments on the evaluation for PERS, which is our largest system, and following along with the teacher system, our market asset returns averaged 8.78 compared to our assumed rate of 7.65, so that is a bit greater than expected. The actuarial asset returns averaged 6.82 versus that 7.65. So that's less than what's expected. Again, this is a reflection of actuarial smoothing of investment gains or losses over 4 years. The market gain of assets on PERS itself was just under 75 million, more than the actuarial value of the assets. And we'll talk about that again at slide 9. The funded ratio for PERS increased from 72.76% to 73.8%. because our assets have increased and the unfunded liabilities decreased. The amortization period increased from 30 to 38 years. So the system is not considered to be actuarially sound. 4 factors contributed to the amortization period increase. First, the effects of the actuarial smoothing. Second, our covered payroll was flat and did not meet the 3.5% assumption. Third, the overall effect of the economic and demographic assumptions that we adopted from the experience study in 2017. And lastly, and perhaps most importantly, our normal cost rate went up, and that's based upon those same demographic features that Director Graham spoke about. Continuing on to slide 5, I probably won't belabor these, talking about the experience study that we did in 2017. Our actuaries recommend that frequent or significant changes from year to year are not recommended, but that we do take a look at them and see if there's a way to gradually improve them. What we did in 2017 is reduced our general wage assumption from 4% to 3.5, the investment rate of return from 7.75 to 7.65, price inflation, which is the basis for all of the other assumptions. You would factor in an inflation rate plus a real rate of growth on top of that to get your actual assumptions. Reduced from 3% to 2.75. I believe that's based on Social Security information, where we get our inflation stats. Interest on member accounts reduced from 3.5 to 2.75, and again, I mentioned that our administrative expense has been stable. The most powerful of the assumptions is the rate of return on investments, and I believe Director Graham mentioned that our rate is above the 50th percentile with a rate of 7.78 since inception. Again, just to make that point, that 7.65 is comprised of an underlying 2.75 price inflation plus a real rate of investment return of 4.9%. Yes.
Interest on member accounts, that's people who don't draw the benefit but simply take their amount out, and is that set by the board each year, or how's that set?
Again, it's a recommendation by the actuaries. Again, it's based upon the STIP rate and treasury bill.
Gotcha. Thanks.
Slide 6 is a graph showing the active and retired membership. We've seen a slow and steady growth, I guess, slight increases in employment over time. The 2017 number, I believe, has some duplicates due to the conversion of our software, and so is probably an outlier with regard to that trend. A gradual increase in retirees, as Director Graham mentioned, is anticipated for any mature system.
So what were you saying about the 17 number?
The 17 number doesn't fit in with that trend. We had converted our software program over the course of that summer, and I believe that our data captured some duplicate part-time employees.
Oh, okay.
So it doesn't fit in with the trend, because you've seen just, very small growth in total numbers of active employees.
I thought those were just the boat inspectors.
Well, we'd have to dig into that. We'd have to query that. Slide 7, again, the average salary of PERS members with the benefit, average salary at $42,942, and retiree benefits, $17,866. So the average monthly benefit for a PERS retiree, $1,489, hardly a golden parachute. Slide 8, Director Graham again explained that these two lines don't have a correlation, but we do like to see them trending in the same direction. I mentioned earlier that we've had a stagnant growth in our covered payroll. It's hovering just at $1,230,000,000, and interestingly, about a $10 million difference would have changed our amortization period from 38 years back to 30.
One more time.
$10 million difference in that covered payroll would have brought our amortization period down from 38 years back to 30. So a very slight impact had a large impact on our amortization period. That's how sensitive these systems are. We've paid out more than $500 million in benefits annually, and more than 95% of that flows through the local economy. Slide 9 is a comparison of the market value of assets to the actuarial value of assets. Very clear depiction of the impact of actuarial smoothing in any given year. Again, Director Graham brought you to the box at the bottom where you can see those market returns from 2014 forward. We're dropping off that 17.1% market rate, and capturing the 4.62%, and it's
And the theory behind smoothing is that you don't, policymakers shouldn't react to any change that occurs in any one year.
flattens the fluctuations of gains or losses.
So, Mr. Schwinn, so let's assume 19, then it's going to have to be greater than the 4.6 in order for it to have any impact on that.
Well, what we would hope is that we've met our 7.65
That's what I mean,
assumption.
between the four.
Yes.
It'd have to be greater than this 4.6 then to have an impact.
Yes.
Positive impact.
Yes. And again, as Director Graham mentioned, it isn't a simple percentage, it is smooth based on a dollar amount. Slide 10 compares the actuarial assets versus the unfunded accrued actuarial liability. You can see the liabilities increasing and assets declining after the 2009 recession, but then the trending is improving asset value and stable liabilities in the subsequent years. 2013 it reflects the new tiers from House Bill 454, and then out to 2017 the liabilities have crept up because of the changes in our assumptions from the experience study that was adopted then. The real takeaway from this slide for me is that we have a real strong growth in the asset base relative to the liabilities over time. Slide 11 is the great representation of the basic funding equation, where contributions plus investment should equal benefits plus expenses. Year to year, the equation rarely balances. The greatest variance is always investment income. So the actuaries smooth those to offset gains or losses over that 4-year period. Slide 12 is the PERS funding results. Something that stands out there is that the normal cost rate had jumped up significantly due to the demographic assumptions and the experience study assumptions that were adopted in 2017. Our expense load has stayed stable. The rate to pay down our unfunded actuarial liability has decreased, but it's still in the positive numbers there. It went from 6.31 to 6%, and that's the amount that's used to pay down the liabilities every year.
That's the amount required to pay down,
It's the amount that's left over to pay down.
amount that's left over.
Yes, it's not required, it fluctuates.
Okay.
But as long as we're in positive territory, we are paying down the liabilities.
Right.
We transfer money to the education fund, where we have a training staff that goes out and presents retirement information to the public employers. Our statutory funding rate has crept up by 0.1%, again due to the employer increases from House Bill 454. The overall liabilities increased slightly, while the actuarial value of assets increased. And as I mentioned earlier, the unfunded accrued liabilities went down, and that's the reason for our improved funded ratio. The amortization period increased from 30 to 38 years, again, because of investment smoothing. The normal costs are up, the flatness of our covered payroll, and the experience study assumptions. Yes?
How much does the employee pay, or does it vary by,
The employee rate is 7.9.
of the,
PERS.
PERS, yes.
so of the 16.57, 7 point, whatever you just said?
Yep, employer is at 8.57 and employee 7.9. Slide 13 has the results for the other plans that we administered at Empara, and I'll go through those quickly unless you have questions. The judges system is in very good shape, as you might imagine. The funded ratio decreased a bit because of the effects of Senate Bill 1 in the special session, recent special session, which called for an 18-month holiday in employer contributions to that plan. The Highway Patrol stayed stable with regard to the funded ratio, amortization period increased, again, for those same reasons that the demographic assumptions hurt them, and their investment return was less than expected. Sheriffs are in better shape because of House Bill 383, which passed during the last regular session, increasing the employer and employee contributions slightly. Employer contributions went up by 1.25%, and the employee contributions by 3%. And so their amortization period decreased, and they're in better shape. Our game warden system continues to need some help, and we have proposed a funding bill for this next session to cover that. Oh, I'm sorry.
And Dory, with that, we don't need a lot of details, but what's the basic plan for game wardens?
Game wardens, we're going to start out at the same position we were last session. It's the only plan we have where the employees pay more than the employer does. This is the correctional officers, the game wardens themselves, some of the security people at the bases. A real wide range of salaries that are there. So we're going to start off with a 2% employer increase. Last time that bill made it to the final days of the session before it died a slow death in Senate Finance and Claims. They increased the employee contribution to match the employer, and I think that the unions representing the employees were not that thrilled with it at that time, and so it died a slow death. But we're going to start the bill off in the same manner with a 2% employer contribution.
And what would that do to the amortization period? You have a
Well, obviously, the actuary would say that it's going to amortize in 30 years or under. That's what we're shooting.
Oh, okay.
Yeah.
That would get it to 30.
That would get it to 30.
And then, is there any external funding, or just increasing?
Game Wardens doesn't have any additional funding sources, no. Yes, Mr. Chairman.
Why is the judge's retirement system ahead of all the rest of them? What was done there that's different? Higher salaries or?
Basically higher salaries. They tend to work longer. They have a very good employer contribution rate compared to the employee rate.
Is there still a filing fee? Is there?
I'm not sure what that.
When that wasn't, at one point there was, they increased the filing fee for filing a case in court, and then that increase went into the system?
I don't believe so. I don't know. I'll just tell you that the employer contribution rate for a judge is 25.81%, and the judge themselves contribute 7%. My basic answer to your question, Mr. Chairman, they're judges.
They don't retire.
That doesn't help.
I have their demographic information if you're interested. It's in
Oh, yeah, I know.
the it's provided.
Is that online?
Yes,
That was what we'd said.
yeah, it's in there as well. Any further questions on those systems? The firemen and the volunteer firemen are both in good shape. The last slide we have is shows the progress towards 100% funding in PERS. And if the current actuarial assumptions are met, it will amortize in 38 years or 2055. So I'd be happy to try and take any more questions, but that is the report.
So both Dory and Sean, particularly Dory, if you look at your payroll for the last several years, we've had about a $30 million growth in payroll for a number of years. This year it was flat. I think a number of state and local government reasons contribute to that. Assuming that there's a growth in state and local government payroll, how much of a positive impact would that have on your plan?
Director Villa, I've tried to quantify that in a number. The actuary has said that a $10 million difference in a $1.3 billion covered payroll would allow PERS to amortize it 30 years rather than 38. So very, very likely that we will be ticking back up. Again, the actuaries didn't recommend that we come in with any funding measure. The board accepted that recommendation, and so we're going to continue to look at the economic assumptions. I've promised that Empera will try to sync up our experience study with TRS so that we can have those in the same year. The snapshot will be taken because now our assumptions are not quite lined up. And I think that causes a lot of confusion when we go before legislative committees and start to talk about the impacts of those various assumptions on the plans.
Let me just put it in perspective for the board. The state vacancy savings rate decreases from 6% to 4%. What would be traditional, the number,
Yeah.
you'd be at another $12 million in payroll contributions just like that.
Yep.
So just something, you know, those instances that we don't control, you know, in Sean's instance, when Senate Bill 375 passed, or what was Lou's? 370. No, Lou's, the K-12 school funding bill.
Yes.
There was a huge growth in K-12 employment because the K-12 districts had additional funds to invest. So that's one of the levers that we don't control, but in this instance, in this year, it's the difference between amortization and less than 30 and amortization and over 30.
Director Villa, can I ask you, the layoffs that occurred as a result of the lack of funding for the state, do you have an idea of what that total payroll was in FY18?
I don't know layoffs, I know net, and it was about 18 million. And that's vacancy savings plus RIFs. The MDC closure would have had some impacts longer term. That's a permanent shift. But to put it in perspective, the amortization for the state employee health plan, in order to freeze rates, assumes that 185 employees will come back to work under the state covered by the state health plan. That's about a $5.5 million payroll right there. So the various moving pieces of just the state components of PERS are syncing up that there's got to be some sort of employment growth to make these systems whole, which, given that there's not a $227 million budget deficit, should align.
Mr. Chairman, I'd like to add to Director Graham's answer to some of the significant risks that we face, Jack. I think that California now is pursuing a lawsuit to change the contractual rights with regard to the retirement systems there. That likely will go to the Supreme Court, whichever way it comes out. There are some other states that are challenging that as well. I think those judicial decisions will have a significant impact on how we look going forward.
Could you explain that a little more? I'm not sure what the...
Well, I should introduce my senior legal counsel, William Hollahan, who is accompanying me today to speak about that case, if you don't mind.
It's a case with regard to the contractual, challenging contractual relationships with employees, is that what you said?
Correct. Governor Brown has proposed changes to the benefit structure for existing employees, and that has been challenged by their representatives and gone to the California Supreme Court.
Analogous to what we went through and didn't fly, right?
Yes, it didn't fly, but there's, a lot of speculation in California and Kentucky and a couple of other states that are doing the same sorts of legal challenges, that they may be successful and they may end up going to the Supreme Court.
So there might be some precedent that could go a different way, so that's your point, I guess.
That's the point, and I guess when we talk about these stress tests and low rate of return sensitivity analysis, if you put in 4% as your rate of return, it really doesn't leave you many options if benefits have to stay what they are for current employees. It leaves you the opportunity to increase employee or employer contributions. And so if those lawsuits were successful, it would open up a whole different alley for people to thrive in the systems.
So, no,
Get your shingle on now.
No, thank you. Actuaries,
Okay.
no one called them on it 70 years down the road.
One of the cases, real quickly.
So there's a matter in California. In California, it had this long-standing statute known as the California rule that says the moment you begin employment in the public system, you're vested in that contract right to whatever benefit formula is in place at that time.
Right.
Now, my understanding is the governor's office in California is introducing measures to say in law that if the funded status of the plan reaches a point, the CalPERS system and CalSTRS as well, where they won't be able to meet benefit obligations, instead of raising contributions again, they'll curb benefit payments and reduce the benefit formula for existing members, active employees and retirees, so they'll be getting less of a benefit, which goes against longstanding precedent of a contract right. California Supreme Court will have to rule on that, whichever way it comes out will be appealed under the contract clause of the U.S. Constitution, I would imagine. The issue becomes file for bankruptcy or try and curb benefits. I think you're seeing that in a few states.
Right, but, well, okay. I understand. Thank you.
Thank you very much for the opportunity. It's always a pleasure to be before this august board.
I guess the question I ask every year, and I want to make sure we ask again this year, and this year I'm going to be smart enough to preface it by saying, aside from meeting the assumed rate of return, is there anything that we need to do to continue to have this good work, or anything that we need to do that's, to improve the working relationships between us and you guys?
I'll jump in and just say, communication between the Board of Investments staff and us as the system is the biggest thing. I mean, there were, in recent times, there have been things that we've been brought into the loop, but not until it's basically a done deal, and then we're playing catch up to try to understand. I mean, CAP is a great example. We found out about that basically the day it was presented to this board, and that's a very complicated setup, how that all works. So I think communication is the key, and as far as I can tell so far, I think we're moving in the right direction.
I agree, and our staffs have always worked well together, so I think it's a great benefit to have a member of TRS board and PERB here at the Board of Investments, because we get good reports coming back during our meetings at that board level. But again, as in any endeavor, the communication is the bottom line, most important factor. You've got a wonderful staff here, and it's just a matter of us continuing to keep those lines open and visit about things. We've done that with Director Villa on a regular basis. We're looking forward to a great relationship continuing.
Okay, thank you.
And in all honesty, the communication goes both ways too, right? I mean, we need to be communicating up or to your staff, letting them know, if we expect some uplift in our payroll or things like that affect cash flow, which then affects how you guys manage your cash on hand. We need to be doing that, and that started several years ago, and I think it's getting better each year. So,
thank you.
Thank you very much.
Thank you.
Here we are up to quarterly report time.
Regulate, gentlemen.
All right, thank you, Mr. Chairman. We are on tab 8. Do people want a break, or I see some, Jack, you're looking a little antsy. I might need a cup of coffee.
I hope that's a reflection on your expectations for.
We'll do 5 minutes. Let's get
Like the-
5 minutes if you don't mind waiting.
Yeah, that's fine, no problem. Thanks, Mark. No problem.
My wife would say to say 5 minutes. say 5 years ago, it was 10 years ago.
Thank you, Mr. Chairman. So we have about 45 minutes. We'll go through really quickly just some of the capital markets. It's been sort of a temperamental market this year, and then we'll get into the performance. We're on tab 8. If you go to page 4, as always, we have a short executive summary that gives you a high-level snapshot of some of the drivers of the capital market events for the third quarter. Also get into the portfolio, and the goal is always to give you 70 to 80% of what we're going to talk about in something you can review in 10 minutes. Again, as you know, the markets were a bit temperamental so far this year. Unfortunately, what you saw in Q3 was pretty rosy compared to what you're going to see, at least so far in Q4. The S&P 500 is actually still up for the calendar year, at least as of yesterday, up about 3.7%, but was down about 6% in the fourth quarter. Small cap has fared a little worse, which, as you know, you have an overweight in the domestic equity portfolio. We'll talk about that. That has impacted performance. That's about flat for the calendar year to date, but down 10% in the fourth quarter. International markets have really taken the brunt of the damage this year. The EFA index, which is an index that covers developed markets, down about 9% calendar year to date. And emerging markets have really taken a hit, down about 15%. As we were talking just 2 minutes ago, this is relatively light in terms of drawdown for emerging markets, but it is still painful to have exposure that goes down 15%. The area of the market that provides capital preservation, fixed income, has also had a tough year, with the exception of high yield, which was up a little. The Bloomberg Aggregate Bond Index, which is a broad indicator that's typically used as a benchmark for fixed income, down about 2.5% calendar year to date. There's a mixed message in this decline. The income goes up that you're getting in the future, but obviously the price decline is not something that is welcome to the portfolio. Commodities have also had a tough year, down about 4%, 2% for the fourth quarter. One area of slight sunshine, I guess, was REITs, up about 2.5%. It's not a direct match for your real estate portfolio, but is similar kind of your portfolio. You have had positive returns there. So 2018, it looks like it's hard to tell with some of your illiquid assets not reporting on a daily basis, obviously, but looking, very light positive year or flat year for investment returns, which, after 2017 is never welcome to have that, but it's not entirely unexpected. If Q4 persists the way, it has so far, that's kind of the direction that you're heading. There are a lot of drivers explaining what's been going on in markets recently. You have had some positives, mainly in terms of earnings and economic growth in the U.S., but thus far in the fourth quarter, you've had a lot of concerns kind of swamping that. You have the trade conflict between the U.S. and global trading partners, in particular China. EM has, again, responded with a pretty significant sell-off, and it does look like international markets are taking the brunt of the trade dispute right now, at the very least in terms of sentiment. Also, global growth expectations have been moderated a bit as a result. You've also had increasing inflation expectations in the U.S., and just increased concern that rates are going to rise as unemployment comes down. And the Fed is raising rates, but as unemployment comes down, that can lead to increased inflationary pressure, which puts upward pressure on rates. And then simultaneously, you have the Fed raising rates on the short end of the curve. And then finally, whether there's legitimacy to this or not, there's been a lot of news and some sentiment that with the earnings growth that we've achieved over the past year, above 20% in the U.S., there's some concern that have we peaked out here and things are going to take a step back, not peaked out permanently, but peaked out in the intermediate term, and maybe things will take a step back. Fortunately, as we've repeated many times, you're a perpetuity, at least that's the current plan. And your asset allocation is really designed to meet long-term objectives. It's always tempting, and it's fun to talk about it, and it's always tempting to react to current market sentiment, current market events by making adjustments that may not be in the best interest of beneficiaries for the long term. This board has done a good job of avoiding that, but it's always good to remind investors that you're really not designed as structurally equipped to be tactical. We would add that tactical allocation in our experience based on perceived market sentiment is more often than not, a losing strategy. The bottom line is the factors that shape market returns in the future are really impossible to know, or very improbable to know at the very least, coupled with the fact that even if you're right, one of the favorite quotes that I have is from Keynes: markets can stay irrational longer than you can stay solvent. And to try to beat the market when you have a lot of unknowable factors driving the market, coupled with the factor that even if you're right, it can take a while for that to pay off, is reason to stick with the long-term allocation. So it's always worth reinforcing that at every meeting. I know I say it a lot, but that is the strategy that you adopted, and we encourage you to keep with that. Anything to add, Jim?
I would just say that, with the exception of the first quarter of 2016, which was reminiscent of what happened in the month just behind us, October, the portfolio and the asset allocation and institutional investors generally have had a big recovery and a relatively uninterrupted ride from the very bottom, which was very deep, and the great financial crisis. So, and as Mark will shortly point out, your asset allocation and your fund have done extraordinarily well. We've talked about that over the last several years, about how successful the program has been. And you heard some of that from during the discussions from the actuarial valuations. If the fourth quarter turns out to be similar to October or problematic in some way relative to what we've experienced, it will be useful, I think, not to react, as Mark said, but to look at the behavior of the portfolio over the next year, should those circumstances be in place, and see if there are any lessons to draw out of that. I wouldn't recommend it looking at a month or a quarter to do that. We've always advised against that. But if the circumstances in the capital markets change, the portfolio behavior will change, and it could very well be good. But in a new circumstance, it's kind of like if you have a sailboat and you've designed it and you sail out in nice, strong, unidirectional winds with no chop, and it's great, but the question is how will it sail if there's a lot of chop and if the winds are shifting or very light? You have to have different experiences. The only other thing I'd say is that so far, the weak equity markets, the declines that we've seen, even in emerging markets, as Mark said, which have been the deepest, are not nearly as deep as some of them that we've witnessed in the emerging markets in the past. And so far, the characteristics of the equity decline don't show panic. We're not seeing a rush to treasuries or a rush to safety. We're not seeing spreads in the bond market blow out, as we often do when there's panic. It's been this compression of values that appear to be in anticipation of what Mark said, that earnings growth, which has benefited from tax reform, which has benefited from a very strong business cycle, might not persist forward, so the market is reacting by curbing values in the equity market and squeezing PEs. And if you look at 2018, what you see is PE compression. That's not necessarily a terrible thing for a perpetual fund because, as we've often said, the PEs and other valuation measures for the U.S. equity market have been at the very high end of their historical range now for some time. So These changes are underway. So far, there's not signs of panic, the kind of blow-off selling that you would see. Despite the fact that there are big days that are down, there's nothing else going on in the capital markets that would lend you to believe that this is other than a revaluation. In the foreign markets, as Mark said, they've done worse, but the foreign markets have definitely slowing economic growth, particularly in Europe. They aren't bearing the brunt of the concerns over the trade war. And they have more event risk in things like Italy, in the developed markets, and Turkey, or Venezuela, or Argentina, in the emerging markets. So, I think that Mark is exactly on point. Your asset allocation and overall strategy and decision-making behavior has served this fund extremely well for many years. No reason to change it right now.
Great, well, why don't we move on to the actual portfolio. If you're gonna have there, after the executive summary and capital markets review, there's another title page called quarterly, probably about 15 pages in, quarterly investment performance analysis. And if you go ahead to page 4, you should see a chart like this. So this just captures the 9 different pension plans, which you just reviewed the liability side of the equation, the funded status. About 11.8 billion in assets as of September 30th. Obviously, that's going to come down a bit after, well, at least if the trend continues in Q4. But a pretty sizable portfolio. I remember when it was less than 10 billion. If you go to page 5, you can see the breakdown of the allocation between the cap and the short-term investment pool. Obviously, the majority of the investments are in the cap. The 2% that is in the STIP is largely for purposes of liquidity. Then if you go to page 6, you can see performance of the both net and gross of the total fund over various periods of time. We reviewed some of this yesterday with Joe and the asset class leads. But it's been, if you look at the annualized returns all the way out to 10 years now, I think this is the first time we've seen this where you've met your actuarial, or you've exceeded your actuarially required return for every period, which is a positive. Still lagging a little over 20 years. You have really 2 crises baked in there. You have the .com crash in 2000 and also the great financial crisis, but still reasonably attractive return of 6.4%. And then since inception in 1994, it's pretty much right on target, a little over your current targets right now of about 7.8%. In terms of your rankings, which now, since Cliff is in the room, I'm going to moderate my comments a bit. I think he's in the room. There he is. But it is very positive. I don't want to overemphasize it because this does go, Cliff has made the point in the past, this does go in cycles, and it's worth remembering that. Also, you do have a large U.S. equity overweight relative to other plans, which has been phenomenal over the past 10 years. But if that ever turns, that you could see a change in rankings. But you're pretty much, I'll stick to top quartile over the past 10-year period. And if you look at the since inception, I remember when that, because of the strong performance over the past 10 years, that has gradually moved up. You're slightly below median now. Take these with a grain of salt, they're not precise. But I remember when that was in the 90s, so that's a very positive.
Well, not just the since inception, but even just the 10 years. If we had just transported ourselves back a year or two, we were looking at a 10-year record.
That's right.
So it's much poorer. The changes that this board and its predecessors have made is nothing short of remarkable in terms of consistency of performance.
Do you attribute that to the decision to go to external managers?
I personally think it's, I should say, RVK has not done an analysis of that, and I'm not sure one could be done. But think about all the changes that you did make. The board came in and restructured its investment program, changed delegation of authority, but retained control over asset allocation, which, as we know, is the biggest driver of both long-term return and risk. Spent a good deal of time restructuring the staff to focus on not just external management, but on running a multi-asset class portfolio. You've added asset classes, and the number of changes that you've made over the last 10 years has been very substantial, so I wouldn't attribute it to any one of them. You've added to your passive exposure. You've had a very controlled approach to your active exposure. I mean, it's a long laundry list of things that the board has done, all of which, in our case view, has contributed to good record. But that's water under the bridge. For you, we're worried about the next 10 years.
The only other thing to add here is, first of all, the calendar year to date, pretty much flat with the benchmark. You are trailing the benchmark. We've talked about it numerous times, but I'll repeat it. Some of that, a decent amount of that, from the private equity portfolio. We'll also talk about the domestic equity portfolio. Kind of following up on some of Randy's comments with the difficulty of active management. We'll talk a little bit about that. That's been a drag on performance, but overall in aggregate, this is a plan that's performing very well, and it's difficult to quantify how you're changing governance and some of the decisions that you've made have paid off relative to what it would have been, but if I had to place money on it, my bet would be strongly positive.
So Mark, you're always too positive. Is there any negatives? I mean,
I'm not always positive, but you're a fair point.
I mean, on a high level,
Yeah.
what are the concerns we should be looking at?
If you look at, we'll get into it with the asset class returns, but the domestic equity has trailed for quite a bit of time versus the benchmark. It's actually a little tricky though, because if you look at and I will talk about this in more detail, if you look at the peer rankings, you're actually doing pretty well versus peers. Philosophically, the decision that you made to go passive in the more efficient asset classes and active in the less efficient asset classes, namely small and mid cap, is sensible. That's something we're supportive of. Recently, it hasn't worked. Some of that is the market. So if you look at, Iridium was a good example. So if you look at their performance, they invest in higher quality names that don't have as high a valuation, and those have underperformed. So that is an area of the portfolio we're watching, long story short, but it's not as simple as saying, well, you've underperformed for a long period of time, therefore it's not going to perform well in the future. There are mixed signs there, but that's something that's worth watching.
I would say that I would sort of go to the very highest level and say, one of the interesting things about the restructuring of governance and operations of the investment program here is that the board has delegated more than the average amount for sure peer plans to your staff, and has done so consistently over the last 10 years. And yet, our observation is the board has remained very engaged. Mark mentioned the movement to increase passive exposure in the most efficient parts of the capital markets. That was in no small part a result of the board continually asking the staff and us, should we be doing more, should we be doing this, should we be considering that? And you may recall, I know some of you were here, that was a back and forth that took place over the course of a year and resulted in your senior investment staff proposing a significant structural change. Lots of times we see delegation, we almost see the board disengaging, and that hasn't been the case here. So to get to my point, one of the things that happens with behavior is that it changes when you get stressed. And I think you've seen that at the individual level, both investing and in life generally. You can behave one way when things are kind of normal, but when there's a lot of adversity, you find out sort of who's the more stable decision makers. in the room. So I think that one of the things that we always worry about, and we worry about it ourselves too, Jack, is that if things get stressful, will we be able to keep a level head in terms of the decisions that we make in the portfolio and that we advise you on? That's, when we look back at the great financial crisis, the big mistakes that were made were people who behaved differently at the bottom of the markets than they were leading up to it. It's kind of like a manager changing the way they buy and sell stocks or bonds for you. It's always a worrisome aspect.
Yeah, you asked that, it's good, and I say this, I'm probably repeating myself, but the fact that you asked that question is always a good thing, because boards that may not be making the best decisions often will not ask that question. But I think Jim's point's a good one. Things will not always look like this, and it's tough to find something wrong right now. I mean, honestly, it is. But they won't always look like this, and to be prepared now for how you're going to react to them. Why don't we go to page, any other questions before we get into a little more detail? Okay. You go to page 11 and 12. You've seen these two graphics before. Essentially what this shows is your risk-adjusted returns. So in the upper left boxes on each page, the volatility of your portfolio, and then on the y-axis, your return over different periods of time. Page 11 is 5 years, page 12 is 10 years, and these are attractive outcomes. You're a little higher risk over the past 5 years. It's reflective of your equity exposure likely, but you've gotten a higher return. A Sharpe ratio, which is somewhat blunt, but it captures risk-adjusted returns. If you look at in the parentheses over 5 years, you're in the 20th percentile, so top quartile. And then over 10 years, it looks even better. You're actually less risk than your peers, but you've gotten a higher return. And the Sharpe ratio, if you look at the parentheses, it's the 8th percentile. So there are good results not only in terms of absolute returns versus your peers, but they're good results on a risk-adjusted basis as well. The other thing to highlight is the downside risk, and this is something that we don't know, but it could be relevant if things continue on the path they have thus far in the fourth quarter. That's a measure of your volatility in drawdowns in markets, and you're basically high percentile there, which is what you want to be, which means that you're protecting better than your peers when markets go the other way, and that's consistent for the 5 and 10 year period too. You're basically above median, which means that drawdown is going to be less than that volatility in down markets can be less than your peers.
Well, that's one of the measures that I mentioned earlier that I think Joe and his staff and we will be interested in seeing if there is a down market over the next 12 months. We'll be seeing whether or not this historical pattern of a little better protection on the downside holds true, because it will be a good indicator that the asset allocation is not just poised to produce higher returns, but can offer some mitigation of downside. And we know that the cloud charts that Mark just pointed out are a favorite of ours because they directly answer the question: did you get these returns by taking a lot of risk that was evident in volatility? We're on permanent retainer to the Ohio State Legislature, and twice a year we review all of their major pension plans, which are huge. And one of the things we spend a lot of time on is directional change in the cloud charts. At one point, when we were first retained by the legislature, their cloud charts showed very good returns, but they were way out on the high volatility end of the peer spectrum. And that was the discussion that we had with both the funds in the committee room, as well as the legislative committee itself. And all of the funds have actually pulled in and are looking more like the Montana experience here over the last 2 years.
If you go to page 13 and 14, on page 13 you can see the total assets. This is including the short-term additional investments through the different state agencies in the short-term investment pool and also the trust funds investment pool. About almost 17.3 billion, come down a bit again in the fourth quarter, but that's quite an amount of assets that you have under your purview. If you look at page 14, you can see the performance of these three different investment pools, the CAP, which we've sort of reviewed through the pension plans already, the trust funds investment pool, and the short-term investment pool. The trust fund investment pool has had a more challenging year, and that's due to the fact that it's mostly in fixed income. You do have some real estate in there, which relative to a fixed income index that it's benchmarked to over the past 10 years, that real estate has added quite a bit. Real estate has had higher than 10% return now for 7 years, so that's given a nice boost to the trust funds investments. And then you got a glimpse of this yesterday, but the short-term investment pool has been a net beneficiary of the Fed's rate increases. And if you look at 2013, 14, 15, even 16 to a degree, returns in that pool were negligible. And now with interest rates increasing and your exposure to a very short duration fixed income assets through that pool, it's risen quite a bit. So hopefully the investors in that are happy with the increased return. Move on to page 15, I believe. I think let's see it. You can basically see the asset values within the cap of the different asset classes that you have exposure to. As you know, you're very equity heavy with through the domestic equity investment, international equity investment, and private equity. That's about 63% of the portfolio based on those values. I would also add in high yield has some equity attributes to it. And then as well, the exposure to real estate, there's certainly some equity-like aspects to that as well. So it is an equity heavy portfolio. You have diversifiers in there as well. But if we do have a sustained downturn, that is an exposure that you have, that could result in some losses relative to peers, and that could affect peer rankings, so just to be prepared for that in the future. Go to page 17, and I'll repeat some of the comments on the domestic equity. Performance thus far this calendar year to date have been a bit mixed. Some asset classes and sub-asset classes providing positive performance. I would say it's tipped definitely more negative thus far in the fourth quarter.
Or 66?
I'm sorry. It's 16. Is it? Oh, yeah, it's 16. I'm sorry. At least as of September 30th, you had a very healthy return in U.S. equities. That's going to be more in the low single digits as of today. International equities can be more strongly negative, but even as of September 30th, it was a negative 3% return. You have had some underperformance relative to the index, again, in the domestic equity portfolio. This is something to watch, but it's, again, philosophically, the change that you made, moving to predominantly passive and large cap, and then focusing your efforts on the more inefficient markets does make sense. You're not alone in terms of trailing the index. If you look at your peer rankings on page 19, you can see that you've actually ranked pretty well relative to peers. 5-year, your ranking is in the top quartile. 10 years, top quartile. Past year, a little better than median. So there's nothing, the challenge here is that philosophically you're doing something that we agree with. It hasn't paid, but it hasn't paid for everybody essentially. Well, not everybody, but most people that have U.S. equity allocations. So definitely something to watch, but to the extent that it's more systemic, we would encourage you to hold off on drawing any short-term conclusions from this. The international equity has performed relatively well versus the index, now out to 7 years. And you do have a similar strategy there as well, where you're using passive in more efficient markets and then active in less efficient places, small overweight to emerging markets as well. And you have outperformed pretty consistently now for 7 years. The broad fixed income, we won't hit on that, that's just reams now in the portfolio. I would say on the whole, your relative performance for fixed income since you started tracking these sub-asset classes has been strong. They've been negative returns because interest rates have risen, and that's resulted in negative returns in a lot of these fixed income segments. The exception is high yield, which was, at least as of September 30th, up about 2%. You have trailed there. Your external managers have trailed their index. Joe could probably provide some additional color on this, but these, my understanding is they tend to be a little more conservative managers, and in up markets that can lead to some underperformance. Why don't I pause there? Any questions on those asset classes before I get into the illiquid, the natural resources, real estate, and private equity?
I probably was out when you talked about ranking. Am I reading this right?
No, that's
Some of these are really higher than anything.
Which one?
The passing, right? On page.
It's going to be page 19, I think.
So the broad fixed income is a little challenging because it is now really just one manager. So you're not kind of getting the peer rankings that you had before with the entire pool. So unfortunately, it's less than meaningful at this point. The international equity is kind of the opposite of domestic equity. You're beating the index, but your rankings relative to peers are on the lower end, below median. I'd look more at the 3 to 5 year for that, since you have changed the strategy. It's still a little below median. Some of that is likely you had more weighting to emerging markets relative to peers. So that could be, that certainly over the past year has been a drawdown. But you are beating the benchmark, so it's kind of a mixed story there. The trust funds investment pool, it looks strong. That's going to be to some degree related to the real estate exposure. The real estate, 3 to 5 year looks good. This is a very difficult one to benchmark relative to peers because you don't know what their real estate, their underlying holdings look like. So, I wouldn't say anything jumps out as concerning, especially when you combine it with your performance versus the indices. But I'm trying to think where it might be higher. My guess is where it's higher is the fixed income because that's traditionally been high. But again, you have the limitation of it's not really benchmarking the fixed income.
We've always said to be cautious about getting too enthusiastic about total fund peer rankings because the differences among funds as to how they're constructed, what they're allowed to invest in, what the strategies they're pursuing is substantial. When it gets down to the asset class composites, though, the peer rankings have a bit more meaning because everybody is now in a tight box. They're investing in the same universe, and so they're on more equal footing. There are differences, yes, and as Mark said, your domestic and international equity are almost the mirror opposites of one another. On the domestic equity, your structure is falling a bit short of the benchmark, but your rankings, how well you are executing in the market climate that all institutional investors face in the equity market is actually quite good. In the international side, it's just the opposite. You're actually beating the benchmark on net of fees, but your peers are actually beating the benchmark by a little bit more, so your rankings are lower. I don't think that there's anything to be terribly concerned about in either one. Another thing that we'll be interested in seeing if we go through a flat to down year in the equity markets, and I'm not predicting that, but it will be an observation that we'll be looking for, is what happens to active rankings versus the passive benchmark. Up to now, momentum has been so strong, the FANG stocks, that as you've heard from Randy and others, it's been challenging for active managers who won't hold the full market weightings of that handful of 8 or 10 stocks at the top of the list to beat the benchmark That could change, and certainly in October and thus far in November, there have been signs that sort of cluster, that top momentum cavalry, so to speak, are dispersing and going in different directions. So this is something we may come back to you in the early part and later part of next year to discuss a little bit more, and we'll be discussing it with your investment staff.
So can I ask a little change of subject? We have some people here, maybe special interest groups or whatever, criticizing some of our investments. And I'm curious to know what other funds do to handle those kind of objections, or what some of their policies and procedures would be sort of in the instance.
To sum it up, I would say it's a very mixed bag. And I hope that doesn't count, Mr. Chair.
And he did one before you came, Mark. He did one before you
I had a
came.
sailboat, did I miss something?
If you're out of the room, it doesn't count.
That's probably true.
You know, I think we set the goals here.
You know, you make a good point.
Well, I don't think, I will give you mixed bag, that's not really a metaphor, it's a common phrase.
Dodged a bullet there.
Don't do that.
Well, that's a common phrase in Montana, isn't it?
Okay.
So, this is, I can't tell you how big the dispersion is on this topic. There are certainly endowments and some public plans that have banned or severely limited fossil fuel investments, which is a very large part of the market. Gun manufacturers, gun distributors, defense companies, and now even things like Google, Facebook for privacy issues. And yet at the same time, there's been a counter move. A member of the CalPERS board was just elected on a platform of saying no more of this, it's just returns, that's all that we should be caring about, and he beat the incumbent in an election, it was Cal Sturz. And so, and there have been a number of funds who have rejected these social concerns and decided to pursue investments so long as they're in legal businesses blessed by statutes of our country and our states. So there is no clear pattern other than a continuing and vigorous debate and lots of dispersion with respect to how boards are reacting. That's the best answer I can give you.
Yeah, and the response to the specific issue that was raised yesterday, well, we can research, what was raised yesterday was a very specific investment. There were public comments on a very specific investment. That's a little different. I almost want to not react right here and just kind of go back and poll our staff as to how you respond to individual situations like that. Because some of it will depend on how much power you have to do anything to begin with, which I'm not even familiar with. I mean, that'd be a conversation with Ethan. So, yeah, I think we probably want to get back to you on that with that specific example.
So, for those boards or trusts who have made the political decision or social decision, however, depending on the lens you look at it from, their return, what happens to their returns as a sort of general rule?
The answer is no one knows. There are people who claim to know, but no one knows. Part of it is because no two boards are doing the same thing. Most of them are doing very little. Some of them, the ones that are doing something, are doing things that are totally different. The only thing that I would say is common would be something like Iran or Sudan. Those you see relatively frequently. And so a detailed analysis of what the consequences are for returns, first of all, there's no category that can be put together versus another category. The CalPERS has actually done some of the more interesting work here, where they've gone back over the years because they've had a history of requiring social actions, divestments, and I think it's fair to say that, and they've done autopsies on them. And I think it's fair to say that they have cost the fund money. Now, for those folks whose social values are so strong, they may say that's tough. From an investment consultant's point of view, and this is our case point of view, we are very nervous about divestment. And the reason is that there's a strong academic argument that the more you narrow your investment universe, the more likely it is you'll either harm returns or increase risk or do both. And so, for example, there was a state fund that I appeared before to talk about 3 gun distributors. During, it was probably 2 years ago, and I said, look, here's the philosophical point of view and the academic point of view. Can I honestly say that if you divest it from 3 stocks that it's material? The answer is no. The problem is that there's a wide array of social values that board members and constituencies may bring, and they accumulate over time if it's the board's desire. And then as your investment consultant, if that were to occur, we would begin to get worried. I don't know if that makes sense to you or not.
Yeah, I think it's important to point out, we're talking about boards like they're generic and their objectives are similar. The cases Jim is mentioning on the endowment of foundation, the extended family office, it's important to point out many of those decisions are supporting the mission of the entity. They are not directly fiduciaries. So they can modify their investments to support whatever mission they have. Whereas on the pension side, by law, we are fiduciaries. And so that is why you see some significant differences between those that are pension funds versus those that are non-pension. It's driven by what the fiduciary aspect is. That doesn't mean a fiduciary shouldn't incorporate a number of these things, ESG termed broadly, because those items over time could have significant impact on returns and therefore should be considered and integrated, not ignored. But there is a difference when we look at a broad universe of boards, what their objectives are and what their mission is. And what their
But we have just one step further, though, too, because we have the standards, both by the Constitution and by statute.
That's the point I'm making, is we...
Well, I mean, not only are we fiduciaries as opposed to the Cullen Family Trust that is subject to the wishes of what the Cullen family wants to do, for example, right?
Right.
So not only are we fiduciaries in the sense that we're managing money on behalf of other people,
Right.
But the Constitution sets up a standard by which we are supposed to do that as an expert investor.
Correct.
And so the question, I mean, that takes us even one step further, what I'm trying to say, than what you're saying. Not only are we different from some boards, but we have a standard that's already set. And so then the question becomes, when we have that standard, and we get the kind of comments that we had yesterday, what's the appropriate way for the board to react to them?
So I think that, that's a Joe, what he's saying is that our mission statement is the Constitution.
Right.
Whereas other boards may have a mission statement that's developed by their creator or their board or whatever.
Right.
So it all comes down to the point that we don't have any control over our mission statement. It's in the Constitution, we have to do it, and we have to totally give it.
Right, and so then the question that I think that Mark and Jim can help us with is, given those constraints, how are we as a board supposed to react when people come before us? And yesterday was a great example, because those were very compelling people, and they made a very reasonable request. And so, but yet, my first reaction is, that's not our job.
Yeah, and I think the broader thing is divesting from energy is
Right, we
clearer,
can't.
but, you know, in this situation, I don't know the details, I don't know both sides of the argument, but if there's a very specific investment and it's also in your financial interest to do something, maybe it makes sense, I don't know, but that was to me, that was very different.
But isn't that, so I'm just searching for an answer. Isn't that really the issue then? Shouldn't we be saying, is this in our financial interest? Saying to the staff, is this in our financial interest? Is that what we should be doing?
Well,
How do you define that though? Because there's a lot of risk we take. And that affects risk.
Well, but to me, it goes beyond that, because I agree with everything you said. But how do we respond isn't necessarily, do we divest ourselves of this investment or not? Some of the requests are, please direct XYZ fund to effectuate a settlement of this dispute. How do you respond to that?
Yeah, I think we need to go back.
Is that even related to our fiduciary responsibility? Is it even related to our duties as a board? To me, that's.
And even if you
well
thought it
beyond-
did, do you have the power to do that?
Yeah.
Well, you have the power to do it, but do you have the right? Is there any effectiveness to that sort of thing? I noted that they quoted one entity as having done so. But no, it was a response to a similar request from the same organization directed towards the Baltimore waterfront area by the another pier. And what they requested was that they direct the parties to resolve the dispute. And so they said, well, the response is, we have been in contact with both Marriott and United Piers to encourage the resolution of timely and adequately managed.
Yeah, so I mean, that's not really doing.
Well, is that something
Yeah,
within our purview?
I think we just need to get back, we need to get a better understanding of this specific
Well, so then,
situation.
follow that up with Dan's information that the manager whom we hired supposedly already signed the agreement. No, the owner signed the agreement and the manager refused to implement it, is what we were told, correct? Correct. So do we want to even get into on that? I'm just throwing that out because you can see where my bias is.
Yeah.
I think that the last letter we gave is similar to what I think our response should be. I don't want to take up all our time right now, but thank you very much for your input. We're a fiduciary, and we'll take that all into account. I don't know that we can do any more than that. That's my guess.
Well, yeah, and I just am curious, and I don't want to, I guess we have these guys here that work with a lot of different funds, and you understand our, where we are very well. Is that, so sort of get their ideas.
Sure, I appreciate that.
Yeah.
So I wanted to kind of broaden the request, if you've got any other clients with those kinds of also nuances to their requests, or
Have you seen them handle well, or handle
To be honest with you, this doesn't come up very frequently. Jim works more with public funds than I do, so maybe you have some examples. I mean, this was a very specific
I've seen the
property.
group, seen the group, well, but let's expand. Let's not focus just in on this, because I've seen that particular group make requests of boards on a number of occasions. And you've had other folks in this room. I remember the pipeline in the Dakotas was a topic. I think that came up here at one point. And I think one of the issues is, what is your mission, and is it given to you along with statutory requirements, constitutional requirements, and fiduciary law? And how is that supposed to make you? How do you pursue that? And the second thing is, can you really do anything? The only things you really could do, for example, with a private equity deal, if you were unhappy, is you would try to sell the fund, your fund interest in a secondary market. And that's obviously a blunderbuss approach, because this isn't the only investment, presumably, that's in a private equity LP interest. The third thing you can do is be encouraging as having a financial interest in resolution, which I often see boards do. But acknowledge that that you don't have the power to dictate or direct these situations. The other thing is that when you think broadly, there's a lot of things that happen in the U.S. economy that people are happy or unhappy about, even if they're legal. And then the question becomes, what's the right venue for deciding whether whether individuals have been wronged here? My understanding, and I'm not an attorney, is that there is a process for resolving contract issues, for resolving abuse issues. I mean, there are venues that if you were at some higher authority, you say, well, have you gone there first? I used to manage a large organization where somebody would come to me and say, I don't like this, I don't like that. And my first response is, have you talked to your manager? That's kind of the first stop. It's the standard stop. And courts, our legal process has a way of resolving that. Isn't that where we resolve these things? So, those are aspects of this that you might want to take into your consideration as you think about this.
Have you worked with anybody to develop a policy plan, SOP, whatever you call it, on best practices on how a public board that is subject to a fiduciary responsibility is, a procedure for how they respond to these things?
Only so far, and this is probably the most common thing that institutional investors, including public boards, have done, which is to require their managers to affirm and sometimes display that they systematically look at things like pollution regulation and labor law violations and all these kinds of things as part of their due diligence on before they make an investment.
Yeah, but my question is, have you worked with the board in terms of how the board responds to the kinds of requests that we have?
But I can't recall a single situation in which a board has adopted a formal policy for these sorts of things, other than to afford an open environment to receive comments. I can't think of a single one. That doesn't mean that they don't exist. I just can't think of it.
We can look at that. I mean, I think this warrants some research, and we don't want to respond on the spot, but we can research and get better answers for you.
It would be helpful in this instance, since you offered to have some additional input.
Yeah.
I just want to guide us towards a general policy too. So
Yeah,
definitely.
I'll be coming in January-ish, so we should
yeah, we'll talk about it.
have that conversation. I mean, one of the margins here is in that in the board's delegation, it's not, they can come to the board to present information, but it's not the board who makes the individual management decisions. So they need to be, the guns are pointed in the wrong direction to add to the list. It's how do we ensure that there is no reputational risk to the board in the receipt of that information, but that it is appropriately incorporated into the staff's due diligence processes.
Well, and I mean, just one more thing, not quickly on that, but I mean, in this instance, for example, they've already gone the route that they're supposed to. They have a proceeding pending, it's subject to dispute, there is a resolution procedure, it's in arbitration. There's negotiation for settlement. What they're asking us to do is put pressure on the parties to settle. We could do that. I mean, it's like Nixon says, we could do that. We could write that letter, but as he said, it would be wrong.
Is this supposed to be,
Watergate for me is most of my thinking anyway. I just wanted to point out that, I mean, when you say we have no power, we have the power to write that letter. It's just not something that I think, but we need to address in the policy do we respond? If we do, what kind of letter do we, and is it simply limited to directions towards due diligence to the managers? And I'm not trying to argue with it, but I'm just trying to make sure we get all the.
I think we just need to provide you with some benchmarks, not benchmarks, but some idea of what other organizations are doing to handle this, and then work with you to set the boundaries of what you are allowed and want to do as a board.
Well, what they're allowed to do is not our, that's a legal issue, that's not our deal. But I will say there's one other thing that is in your power, and that is to say, depending on our knowledge of, that's developed in this proceeding, that becomes part of the potential due diligence record for an investment with this general partner in a new fund. Now, that's going to be a decision you can make, and there's no reason on God's green earth why you can't look at the performance of their previous funds financially, but also from the point of view of headline risk and risk generally based on how they conduct themselves in their investments, and make a decision on a re-up or not. That's Ethan's purview, but at that point, you will have the power to make a decision one way or another.
Ethan's already indicated that's what he intends to do in response to it, so that's
Well, but Ethan, again, without, I'll go one step further, because I think we give Ethan credit for credit's due, which is that not only does he intend to do that, but he has done that with previous funds. He's always looking at that issue. But nonetheless, once you're in, you're in.
Right, and the potential for an aggrieved party to emerge in the literally thousands of investments that you have is incredibly high. And I think one of the considerations the board has to make are you in the business of adjudicating aggrieved parties that are somehow associated with your investments? If so, board meetings may get longer.
Agreed.
Well, not to,
Can we beat that one to death, Mark?
it won't beat this horse to death, but apparently it's legal in Montana.
Only if it's a habit.
How long have you been waiting?
Just last night.
Just let it be known, I did not say this, Mr. Chairman.
Well, that deducts one off you.
But I will say that the two things that I've seen come up are very idiosyncratic. It's not like you've invested in a fund that is solely doing things that are, socially unacceptable to people. These are, one investment with a private equity fund that was doing the payday lending, one investment with a real estate company who is not even the manager of the property. They own the property. So, some of this has to be taken with a grain of salt. But we'll get back to you and we'll go versus dead. Really quickly, just covering the illiquids, the natural resources has been, since added in 2017, has been a net positive contributor. Been a little rocky on the tracking error. That's to be expected. That benchmark is not reflective of your portfolio. So take that with a grain of salt. The real estate portfolio has been really exceptional for 7 years now. Oh, I'm sorry, I'm on page 16.
At the bottom.
The real estate portfolio, both absolute and relative, has been a very strong value added in the portfolio, over 10%, annualized for 7 years. Actually solidly positive now for 10 years, and that's including the historical real estate downturn in 2008 2009.
And you asked for things that have contributed to the board's success. You may recall how painful the first 2 years of that introduction of that asset class was. It was one of the worst times in the real estate market. And yet, as Mark just pointed out, now over 7 years, this has been a positive, absolute and relative contributor to the performance of the portfolio. This is indicative of decision-making for a perpetual fund. You guys decided that it was important to have real estate as a diversifier, it costs some to make that decision up front, but so far it has proved to be a very wise decision. And contributor not only to the cap, but also, as Mark pointed out, to the trust fund itself.
Going to the next page, the diversifying strategies, a lot of that, as Joe mentioned, is reflective of the holding area of TIPS, so you've had a negative return there. But as you know, you've added the GMO benchmark 3, so that'll start getting incorporated into that performance. And then the private equity pool is a pretty similar message to what we've delivered in the past. Long-term absolute returns have been very strong. The index has changed. It used to be a S&P 1500 plus 5%. We had endless debate on that, and now it's switched to just a small cap index. But it's been an extended bull market in public equities. It's basically since the financial crisis, so you have seen some lag versus the public equity markets, but it remains a good diversifier and also strong absolute returns long term, and you can't really complain about the annualized returns, even though it's trailing a public market index over the past year's returned 3.3%. Our expectation, you never know because it's an illiquid asset class, we don't have valuations, but with this recent downturn, our expectation would be that you have some strong performance relative to the public equity market benchmark. That covers I know we've taken up more time than we had budgeted.
Overall, I have you talk for another hour on this, but on our GMO investment, the benchmark is fuzzy.
Yeah.
What do you think about that?
Well, yeah, I mean, we could talk and I'm not deeply familiar with that investment. I mean, I do know the basics of the strategy. I don't personally know the underlying exposure. I know our manager research group does. The challenge with these investments is that when you're using a CPI plus 5%, it's not an investable benchmark. So you will see, over short periods of time, you're going to see pretty significant deviations from that. It is useful and as Joe mentioned, since inception of that fund, they have outperformed the CPI plus 5%, modestly. So it is useful as a benchmark to gauge whether you're potentially sacrificing more return than you want to for the added diversification. It's also going to be important to track the diversification. So this is an investment that is intended to provide, a solid absolute return in a way that is different and unrelated to other areas of your portfolio. And making sure that that's the case going forward is going to be important. But it's a difficult issue. If I had to summarize, it's long-term, it's important to get a reasonably attractive return from that investment, and that benchmark can be useful as a directional gauge. But almost equally important is it providing diversification that you are seeking?
So I would answer the question quite simply, and that is that I think we would rather see the portfolio have the best investments that it can, even if the benchmarks were fuzzy and therefore it challenged the board's ability to monitor it carefully, than to have second best investments that had very clear, absolutely applicable benchmarks. And it kind of comes with the package. As we just went through private equity, maybe the single most difficult to benchmark asset class, and yet the absolute returns and the contribution to the portfolio are so large that I don't think this board and past boards would ever give up those absolute returns because it was more difficult to monitor because the benchmarks were different.
So that pretty much covers the portfolio. Any additional questions, or we'll turn it over? Great, thank you.
Thank you.
just say, I guess I'm on tab 9. You see the memo there, just some language changes to align with some of our other changes we made to some reporting. The only other comment I would make is that within the larger separately managed accounts investment policy document, there's an appendix, as you recall, that's some 70, 80 pages with each individual account that has objectives and guidelines. I did change trust fund to trust funds in many of those, but didn't feel the need to print the extra 70 pages and show you the red line for that, because it's kind of a just a clean up. So I'm happy to answer any questions about it, though.
If not, Mark, I'd make a motion to approve the new Montana separately managed fund investments bond.
I do have a question.
Well, if we have a second, we can have discussion.
Have a second.
Go ahead, Mike.
So when I'm looking at Montana code, they identify, the language they use is separate investment fund. Why wouldn't we use something similar to that?
Why wouldn't we, what, I'm sorry?
In the Montana code, under the state finance section, they reference these as separate investment funds. So it seems to me, why wouldn't you say separately managed investment funds?
What code section maybe are you looking at?
It's section 176203.
So, all of the funds on Savers and all of our participant funds, we have a separate Savers fund number. So we are referencing and tracking everything separately on Savers.
I understand that. I'm just asking, my question isn't how we're accounting for it. My question is, if we're looking to update language and change it to make it consistent, why wouldn't you add? Go ahead, Jeff.
We can change it to whatever.
Yeah.
This change is recommended because that's what we incorporated recently in our financial statements. But if the board or anyone feels strongly there's more appropriate language, you know, this change that we're recommending today was to try to move in that direction for consistency. If there's another step that would be beneficial to take to tie into code, you know, that's something that we can easily do. We don't have a strong opinion about the exact wording other than the consistency of it to hopefully reduce any confusion of.
So, excuse me.
Go ahead, sorry.
So Maggie, what would the statutory language be instead of separately managed investments? What would it be from that?
It just says separate investment funds is what they're talking about. And it should, to me, it seems separately managed investment fund.
But does that code address all of our funds, or does it just address those that aren't cap or trust?
Now, that code
It's everything.
section, if I read that statute is applying to the Unified Investment Program in total.
Okay.
And within the Unified Investment Program in total, we are tracking everything by Savers funds that are separate. Now, when we talk about retirement system, we track the participants within our CAP, which is a pool, or STIP, which is a pool, and we are tracking our participants with separate Savers funds, but we don't refer to STIP participants as funds. It's a STIP account or a participant account.
But I think Maggie's issue is, why are we using the term separately managed investments as opposed to the term separate investment funds?
1762, section 203. But even STIP is identified as short-term investment with local government funds, so it's got funds in there.
It does.
Everything in that section isn't just the unified, it's all state finances. I'm just,
Perhaps we,
it's not a big deal, but
well,
it just seems like consistency in my mind.
it makes some sense if there's statutory, I mean, it should mirror the statutory language as closely as possible, if that's what the intent is, it seems to me. Should we, you want to postpone that and review the language and come back with a recommendation?
I think for the purposes of our financial statements as they're presented at the end of the calendar year in our annual report, it would be most helpful if we adopt this today, and then we will work with our legal beagles and our investment team, that if we need to revise it again in February for the purposes of mirroring code, because I think it does make sense.
How about if we adopt this or revisions that staff deems necessary to mirror the code, and we can just, would that be acceptable to
I
you?
would accept that.
Okay.
I would modify my motion.
If somebody had a second.
I did, and I agree.
All right, so the motion is modified to the separately managed investments as the language to substitute, or such other language is deemed appropriate by the staff to make it consistent with the statutory language. Any further discussion on that? Those in favor say aye.
Aye.
Opposed, no. That carries. You done? You just say you wanted to break your one more.
Let's more talk about it, just finish it.
Okay.
You want to take a
We'll go ahead, well, we have Jack, you the break, Chairman.
It's up to you, you're the boss.
I know, but I'm asking you, do you need a break?
Well, now I'm looking at the clock and I'm anxious to get done.
Well, I thought I'd check with you. Go ahead, Joe, you're on.
Thank you, Mr. Chairman, members of the board. Turning to the last tab here, tab 10, to talk about the asset allocation with respect to the pension plans. So starting off in this presentation, for those of you who were here last year, much of this presentation is very similar in terms of the key points, but I thought it was important to review again and repeat, both for the new members of the board, but also for all of us, because they're important themes to go over, as already pointed out, and asset allocation remains critical. So that's kind of the first key takeaway. Something else we've already talked about today. It's about the prudent expert principle, making sure that's integrated into what we do. I'll talk about that a little bit more in a few minutes and get more specific. We talk about peer comparison, but it becomes a real challenge on asset allocation, because there's no asset allocation that is right and wrong in independent investment space. There's asset allocations that are more appropriate for circumstances, and we need to incorporate our plans and our situation to help determine what the appropriate asset allocation should be. There's a lot of things that we incorporate into this. Some of them, we're not going to dive into the details of the liabilities, but some of the things that Sean and Dory talked about in their presentation are critical for us to incorporate. The one that I'll highlight in this presentation is liquidity needs. Our near-term expected benefit payments that we need to make. The actuarial assumptions in the last bullet here, noting that they've decreased a little bit recently, as I'll talk about in a few minutes. That the precision of those numbers are important, but within the scheme of how we think about asset allocation, those numbers are just about on top of each other. And so we're mindful of those numbers and how they evolve, but the fact that they evolved and decreasing those assumptions the last few years has not had a material impact on how we approach asset allocation, and it's not impacting this recommendation. They're very consistent with the longer term numbers and assumptions. Turning to page 3 to continue with these key takeaways. Again, the staff and RVK has already talked about a lot of this economic stuff that's kind of built into the consensus. No one foresees an immediate recession. The general economy, particularly in the US, but even across the world, sure, there's problems, but generally speaking, it's still more one of gradual growth than it is, significant declines, especially in the developed countries where the majority of our investments take place in the U.S. But there are things that are changing. The Federal Reserve is reversing an action that they took after the crisis to remove significant amounts of liquidity, and as part of that step, they're raising Fed funds rates, and as John mentioned yesterday in the fixed income presentation, the Federal Reserve has a portfolio, and they're changing the aspects of that portfolio. This is really just reversing very significant actions that they took post the crisis. So it's things that people view as a consensus, nothing kind of shocking here, and all these things are incorporated into how we think about asset allocation. I'll talk more about liquidity. I guess I already have talked about that point, but that's critical to some aspects of the asset allocation recommendation. The risk allocation, RBK just presented, and we continue to present very long-term positive return numbers. But to answer Jack's question, what are we concerned about? Well, we should look at the risk that we have, and our biggest risk is equity risk, and the equity risk is tied to the growth of these economies, and if that changes our portfolio performance, shorter term, potentially even longer term, as Jim talked about, there's a big difference between what happened in the last market downturn and a quick recovery versus the depression. So if growth would remain subdued for a long period of time, that is a major risk in our portfolio. Because the portfolio is significantly positioned in that way, and that's where the majority of the risk is in the portfolio. The reason for that is the objectives of the portfolio. We can only achieve the actuarial assumed objectives if we take that risk, because it's that risk that pays us enough to achieve those objectives. If those objectives were deemed to be change over time, and then that would modify our view here and potentially our risk exposures. But because those objectives have been pretty stable over time and consistent with long-term returns, and because we continue to be a long-term investor, the risk that we will take will be very much tied to the growth of economies and therefore equities. And so that's the biggest risk in the portfolio. Over time, we are doing everything we can to reduce that risk and make it less concentrated. That doesn't mean we're entirely stepping away from this growth or equity risk, but we're looking to get different varieties of equity and different exposures to that using both public and private markets. These last 2 points somewhat talked about, and Dory and Sean covered in their presentations. I'll talk about it a little bit more in a few minutes, but the expected return that we have on our assets today, if you have an intermediate to what even some people might call a long-term time frame, 10 years, we're below the actuarial assumptions. That doesn't mean next year we're not going to have a return above that. That's what's happened in the last few years. And as we'll talk in a few minutes, that's within expectations. But currently, thinking out 10 plus years, our expected returns for these portfolios are below the actuarial returns, but it's important to remember those actuarial returns are not limited to 10 years. They're thinking about 40 and 50 years. And for that, those things necessarily aren't inconsistent with each other. We could have returns for the next 10 years that are below and still achieve those returns over a 40-year period of time. However, the reality is if the return over the next 5 or 10 years are below, and as the plans themselves address these things, they're going to come in here and talk about changing funded ratios and amortization periods, and so probably if over the next 5 to 10 years we're underneath that actuarial return, there will be implications in the asset allocation we'll continue to respond to those choices that are made about contributions or benefit payments. So we're not looking to drive that, we're looking to take that as all inputs and assumptions to our process to determine the best asset allocation. And then the last point, of course, shorter term fluctuations. We're not going to have a nice, smooth, exact number, year in and year out. But before I get into some of the details on that, I went through that pretty quickly. I think it's important to pause and if there's any of these points that I can kind of clarify, or as I go through this, speak in a little bit greater detail. I'd really appreciate any questions you might have.
This is just a comment. I think the graphs you have on 6 to 9 are great. I don't think we've seen these before. And I think these are excellent, really make the point.
Okay, I'll try to rush and get there. Maybe I'll just skip over page 4, kind of let you read that, but we're thinking both from financial and fiduciary standpoint, those are our objectives. Page 5, this is the law. This is our playbook. This is, from a communication standpoint, what we tell everybody, whether it's the participants in these plans, managers we deal with, the media that's asking us questions. This is what we always go back to. And because this is, until this change, this influences everything that we do. And so every action, I believe we can tie back to this. And importantly, it's defining what the prudent expert principle is, but discharge the duties in the best interest of the people that we're managing the assets for. Diversify the holdings. Those are pretty simple, and time and time again, we're trying to confirm that that's what we're doing, whether it's the regular reporting we do to you, or how we respond to questions from outside the Board of Investments. Because not everyone shares these same objectives. Not everyone is acting in the best interests of those people that we're managing assets for. And we don't expect that they will. They're acting in the best interest for who they're supposed to represent. But in communicating with them, we want the information that they have to integrate it into our process, but our response to them is always tied back to this. In getting to the pages, Terry talked about, there's a few here in a row, and I think these are helpful to give a sense that what happens, not just over the last quarter, the last year, but over history. All of these come from JP Morgan, and these are from their September publication, so you could argue that maybe they're a little bit dated in terms of the year-to-date number, but more importantly, the first one on page 6 talks about U.S. equities using the S&P 500 market. The key takeaways for 29 out of 38 years since 1980, the markets have been up. That's somewhat what we would expect, right? We expect people should be paid to take equity risk, and we expect over time there should be returns consistent with that. And that's why we have had, for a long period of time, and expect to have going forward, in equities as a key part of our portfolio. But more important, I think, to also learn from these pages is the inter-year drops of almost 14%. And we've experienced that now almost twice this year, at the beginning of the year and the last months. But if someone just started, a year ago, and now we're here today, they'd be like, well, what's changed, right? Well, a lot. We've gone up a fair amount and down a fair amount. And those things, I guess, some people would suggest that shorter term volatility should be ignored. My view is not entirely that. To me, that is a risk. No risk should be ignored. We don't have to respond to every small change, but sometimes the market swings one way too far, and making the market look more attractive and our investments in that market, and sometimes the other way. And I think to ignore that is to ignore those things that I just pointed out and act in the best risk of our fiduciaries. Now, that
So does
doesn't,
that mean that in the average year, the market will at one point drop 13.8%? Or does that mean that in the average year, the difference between the high and the low is 13.8%?
the last part, closer to the last part. So these are all calendar years since 1980.
Right.
And if you looked at kind of the high point of that year to the low point of that year, on average, it's been close to 14%. But for each year, on average, the actual calendar return is positive. That's what the bars are at the top. And that's what we concern mostly about. But it's to say, particularly as a plan like us, that we have money going in and out, we should not ignore these swings in the market.
And
Right?
Mark's question to me was, is this saying that when there is a drop, the average is 13%, or is he saying, or are you saying that in every single year you will have from high to low an average of 13.8%?
No, so let me see if I get the question right. These bars here on page 6, the gray bars that are mostly on the top, those numbers correspond to the return of the S&P 500 for the calendar year. The numbers that are below each of those gray bars, to me, it looks a little reddish, and in most cases they're negative. That is the drop from kind of the high point of that year, which may not be the end point, right? From the high point of that year to the low point of that year. And you see in some years...
well, those are the numbers.
But there's one bar in each year.
Yes, for the returns in that
Each
year.
bar has a year.
Each bar has a year.
And why does it say, despite average intra-year drops of 13.8%?
Because then if you take all those numbers that are below the bar, so look at 1980. 1980 produced a 26% return for the year. But if you looked at the high of the year to the low of the year, any point during the year, it was minus 17%, right? The biggest drop. So,
say that again, please.
So if you look to the left-hand side of the chart, 1980, there were two numbers associated with that. The bar goes up above the axis line. It says 26. That means for 19...
So the dot is the lowest point of the year?
No.
The dot, the upper bar, the 26, is the performance for the year, January 1st to December 31st. The dot, the minus 17, is at some point in the year.
Right.
The change from the lowest point in the year to the highest point in the year. That was 17%.
So if the high point of the year was February 14th and it was at $100, the low point of the year may have been September 28th or some other point, and it would have been 83. And there was a 17% change from that.
Yeah, okay.
So it's high day to low day.
And I'm not trying to bring you into all the details of the numbers.
No, I'm just trying to understand the chart.
Yeah, the key takeaway here is equities over time, and if you think back to the 1980s, it's been generally good, but there have been some pretty bad periods. We've had recessions, we've had some struggles, but generally over time, the equity markets have taken that into account, and in the vast majority of the years they've produced a positive return. But during the year, what we saw in the first part in January this year, what we have seen in October is not unusual, right? And to Jim's point, it's this is just important to keep that in context such that we don't overreact to shorter term situations. We understand shorter term situations within the concept of longer term history. It doesn't mean we ignore it, we need to take it into account, but we want to make sure we're not overreacting.
Don't panic on that.
No panic.
Right.
So the next few pages,
When do we think?
page,
When do we?
we don't. I said that.
Well, if Mark's out of money, he's stuck in a foreign country.
He needs Apple Cards.
So on page 7,
That's
again,
from Canada, by the way, when you're out of money in a foreign country.
Page 7 is very much the same message, but you'll see here it's MSCI EFA. Again, that's an index that represents developed markets outside of the United States. And you can see it's very similar. The number of years of absolute return, the interdrop per year is about the same. But you can look very quickly and you can say, okay, well, the absolute returns actually for the U.S. market over these time periods have generally been higher, especially in the last decade. And as Randy pointed out yesterday, as I pointed out yesterday, as RBK talked about today, our biggest position in our portfolio is our weight in U.S. equities. That's been a very good place to be the last 10 years. That has been a very good place to be for even since 1980. That doesn't mean that comes without risk, right? And that doesn't mean we're necessarily going to have an exact repeat of the last 10 years or the last 30 years since, in the next 10 or next 30. So we're always keeping those things into account. But it shows things aren't linear, things will change, and we need to incorporate that. Flipping the page to page 8 is the same thing, but now we're talking about bonds. And we're talking about U.S. bonds, because this is the index of the U.S. aggregate. And as you'd expect, most years since 1980, bonds, so what, 35 of 38 years, it's positive return. But the returns have been more muted than the equity markets. And therefore, that's why today, and historically, they have not played as large of a role in our asset allocation because they're not as helpful at achieving that growth. But because we have less numbers, less bars below the line, and these numbers that are below the line, they're not as extreme in negative territory, either each year or inter-year. That's why bonds play a significant role in the portfolio in terms of diversification. We're now this year, if the current trend continues, we will be on the minority here. We will have a year that's expected to produce a negative return for this particular index, the Bloomberg Barclays U.S. aggregate. So our portfolio then is not all in U.S. equity or non-U.S. equity or bonds, where it's an asset allocation. And page 9 gets to that in the simplest form it's usually talked about. It's the 60-40 mix, 60% equities, 40% in bonds. In this case, the equities are only represented by the S&P 500 and the bonds only by the U.S. Ag. And you'll see over time, since 1998, which is this chart, which has been a decent market for equities over that time period. And you can see that because the S&P 500 is a dark line, has increased. $100,000 would be $345,000 at the end of September. That's good, right? That helps our investments. But if you look at the 60-40 portfolio, that's 60% those same equities, but 40% of bonds, as of September 30th, from the start of 1988, not as much, right? Now, if we look at this number in just a quarter, it's going to change again, given what the equity market. But for the vast majority of this period, the 60-40 line actually did better than the equity line. And the reason for that is if you look at 98 to 2008, and you look at the line just for the S&P 500, it was almost a lost decade in terms of equity returns. So significant period of time, didn't get that growth for equity. Bonds played a meaningful role and it helped out. Now, since 2008, or really post-crisis, equities have done great and been the driver of our returns, and that's why we've achieved those positive numbers consistent with the actuarial return. But in the first 10 years, that's where bonds play a bigger role. And it's asset allocation that is critical to us to manage over time and determine a return that has some stability in it, but over a longer period of time achieves our goals for these plans. Any, again, questions about these return slides before moving forward? Just trying to build the reasoning, how critical equities are, but also how critical the non-part of the non-equities in their portfolio are. Page 10, we could talk for a few semesters in a academic setting about this, but what we know about asset allocation or models aren't perfect. A lot of the models are extremely good and they've gotten better over the years. What really drives the reason models are not perfect, they are helpful, is the assumptions are not perfect. And so it's the assumptions that go into them that drive the output. And so we need to be even more aware of the assumptions before utilizing an output of the model. So there's no model, there's no correct, here's what we can use and it's easy to solve. Qualitative judgment must be incorporated, understanding how people looking in these situations, how they might behave, how the market as a whole might react. Models have not been a good predictor of behaviors in the market. And so we're taking that into account. Page 11, Dorian Sean covered all this. I've kind of just moved around the formula down here at the bottom of the page. And the reason for that is every quarter we come in here and we talk about a net cash need. Well, that's embedded in the same formula that Dorian and Sean are showing you. And so the investment that we do and what they call income, we call total return, right? That total return from the investments and over time needs to equate our net cash need from now until forever, right? That's simply our goal. And that's what that formula does from an accounting or actuary standpoint, but from an investment standpoint, that net cash need, what we need to pay out next year, over the next 10 years, for the next few hundred years, is really, what influences the investment objective. Shorter term, page 12, is really the cash flow analysis and thinking about liquidity. Because it's great to be a long-term investor. I forget the quote Mark just used, but basically, if you ignore what your short-term needs are, you're going to be in trouble. You can't always totally think about the longer term. So we need to think about the liquidity payments we need to make this year, next year, and over the next several years, and make sure we're always in a position to provide that liquidity and provide these payments that need to be made without doing harm to the rest of the investment portfolio. And by that, we don't want to sell assets during this part of the cycle when markets are underperforming, or even this part of the year that markets might be down 14% on average from their high. So we're managing liquidity in a way that we have enough liquidity to meet the nearer term needs while still thinking about how liquidity needs are going to change in the years to come. And so page 13 is how we think about that on an annual basis. And we get this information, in page 13 from TRS, thanks to Erin for collecting all that and putting this all together. And the right way to look at this page is on the white left-hand side of this graph, that's the past. And you see in the past, these lines below the zero kind of axis here are always negative. So we're sending more money out than's coming into the plans, and they've been growing, right? Not a surprise, not a problem. That's the objective of these plans, to make benefit payments. But as we look forward, that's important and should influence our strategy and what liquidity. So the gray, the right-hand side of this graph, is, well, what's going to happen in the future? Well, we expect the recent trend of the last 10 years is going to continue. And we expect that growth, those lines are going to get more negative and bigger each year. As Sean pointed out in his comments, that's not necessarily a problem, but we need to take it into account. Hopefully, each of these years and 10 years from now, the plan is bigger than it is today in dollars. So we're incorporating that, but it's important for us to understand, and as noted in the second bullet here, over the next 10 years, the rate of growth is about 5% a year. Very similar on the next page, page 14. This is just for PERS. It also is approximately 5%. You know, the numbers aren't exactly the same, but from a big picture standpoint, our growth of our net cash need is about the same in terms of the growth of those dollars. So this, from what you heard from Sean and Dory earlier, this is trying to take all of that information and incorporate it to how we think about asset allocation. And so, okay, we understand that the net cash need is going to continue to grow, but what does that mean for the liquidity of the portfolio? That's on page 15. And so on page 15, we look at each of these plans, and the MPAR plans are listed first with PERS at the top and then the teachers at the bottom. And for the first column is 2018, what the net cash need was. It's important, you know, we're highlighting the two biggest plans, PERS and TRS, and what their numbers were. That's what I did on slides 13 and 14. But in looking at these, 3 of our plans had a positive, right? So more money came in than went out. So situations are similar, particularly for our largest plans, but not necessarily the same for all of them. And we want to be aware of that and take that into account. That, again, is not having a great impact this year in how we're thinking about asset allocation. But it does show that we should look at the details of each of them. The second column, yes?
And if this gets us off topic, just tell me to move on, but how is it that the worst funded plan, the game board,
I can't answer that. And I wouldn't even want to try, right? And I'm not suggesting that positive is good and negative is bad. These are just the facts, right? And these are the facts that are passed along to us from the plans. But I know that for the numbers here that are negative, right? For this past year, and the numbers that are expected to be negative, that means a net cash need. That's what's important to us. How much money do we need to have available next year such that we can pay a need? The specifics of the plan and what their cash flows are and what they were last year or might be next year gets a little beyond our scope.
So you could have a poorly funded game board plan, but you just don't have any retired game boards.
Right. Yeah, and at the end, if we go back to that formula, right, there's an investment, but then there's contributions, benefits, expenses. Expenses are generally pretty small. This number is negative if the benefit payments are greater than the contribution, which are tied to the demographics. And in the cases where the contributions are greater than the benefit, that's also tied to the demographics. And the decisions that the plans and the legislators have made historically about, what the level of benefits and contributions.
It's probably just safe to say that even though there's a net cash going into the plan, it's not enough to pay for the projections out 30, 40, 50 years.
Sure. Yeah, so this number, that's a great point, Jeff, because this number only talks about the cash flow next year. It doesn't talk about the funded status. It is, let me, before I get to, let me talk to a few of these other columns on page 15. So the second column here, it says expected 2018. That's a typo. That should be 2019. So it's just looking forward 1 year. And so as we look forward 1 year and took the numbers from the underlying plans, these are very manageable numbers. The minus 3.7% for teachers is saying, at the bottom of the second column, that's saying We need about 4% of the current assets to kind of pay out next year. Very doable. That's when we look at, broadly speaking, institutional investing that's going on, that is a low number, right? On general, endowments of foundations and many pension plans are paying out a number higher than that. So very manageable. So the liquidity needs today, next year, we want to be aware of it and manage it for it, but aren't significantly influencing the asset allocation here. That means we can be a little less liquid and get paid to do that, and hopefully help returns. Now, the last two columns are going out 10 more years to 2028 and using the expected cash flows from the underlying plans. The difference between these two columns is in the second to the right, you'll see, as noted in the header, goes up to 2028, but the assumed investment return is 7.65 every year. And the far right column is 3%. You notice that has significant impacts. And so again, this isn't concerning at this point, and it's not, we're not projecting 3%, we're just looking at scenarios here. If, though, over the next 10 years, we average 3% return, using teachers as an example, the liquidity need in 2028 would represent almost 10% of the assets. That, by that time, would be impacting our asset allocations with an assumption no changes were made to the plans, right? So if the plan did, say, made more contributions, then this number might have no meaning at all, right? So it is holding everything constant other than the investment return.
So why did you pick 3%?
We could have picked 0, we could have picked a negative number, but 3% is a positive number, right? And I'm just showing some significance between a 6.5, 7.5% number and 3%. There's nothing magic about 3%. But 3% was the number that got us to 10% of teachers' assets would be paid out in that year. So it's more that drove the 3%. It's not a...
If you went out further, you should end up at 7 in that second to last column. Second to the right-hand column. If you went out 30 years, theoretically, you should end up at an average of 7.65% or so. Isn't that the point? Is that you're supposed to have a cash flow of it if it amortizes?
Now, if it's fully amortized, right, it's 100% funded. At that point in time, it might keep going the other way. There might be a positive funding. We might have more contributions coming in than going out. So this, again, isn't talking about funded status at all. It is only focused on our liquidity need. And it's important, the other reason for 2028 and not 30 years is our illiquid investments in the private space and the real estate space are generally 10-year term in nature. So it's this time frame that we should consider. This time frame that I'm showing you today, there's nothing on this page that suggests that we need to change the liquidity profile. There's no major concern, right? But it's just showing these are the types of things we're looking at. If you flip to page 16, these are the facts, right? Dory and Sean, the first two columns, they said today what the actual return was and the assumed inflation for each of those plans. And in April, RBK provided their thoughts on our asset allocation mix, which is very similar today. And I asked them before putting this materials, they had no reason to meaningfully change these numbers. Markets have gone up and down since then. But their return expectations are different than the actual return expectation. One could look at those numbers and say, wow, 100 basis points, 1% lower, that seems meaningful. Yes, in terms of the precision, yes, if that were true over a 40-year horizon, not so true any year-to-year basis. And that's really what page 17 is getting at. And again, this, thank you to RBK, this is from their presentation in April, but I think it's important as I'm putting forth an asset allocation recommendation as a reminder here. So this is a normal distribution. Up at the top is the detail of assumptions, expected returns, and that from the RVK analysis. But I'd ask you to look at the graph at the bottom, the normal distribution. And right in the middle of that is their expected return at 6.57%. Now, again, that return, we have no guarantee, so we use statistics and normal distributions, and that's where this whole discussion of volatility and standard deviation comes into account. And so the first standard deviation, one standard deviation change, is the gray, going both ways from that middle. And that's, approximately would be about, mid-60s percent in range of the probability of the scenarios we think are going to come in within that. As you extend out 2 standard deviations to include the light green, that's now, we would say in terms of statistics, 95% of the returns that we expect next year could come within this range. But that range is huge, right? I mean, we look at that and we say, okay, that's from 19.47 negative to, to 32%, right? That is like some of our worst years for our plan, and 32%, I don't know as a plan if we've ever achieved that on an annual basis, right? So the important thing to take away from this is we don't know for certain any one year, but it's these longer term returns that are critical, and that's why we're making asset allocation investments for the longer term. And as people talk about these even long-term return numbers and try to compare them directly, if you look to the middle of the chart, they're almost on top of each other. But for the longer-term return, if we got a 8.5% return instead of a 7.5%, we're going to be meaningfully better off over the next 50 years. But if we get a 6.5% return instead of a 7.5%, there'll be work to do between now and that 50-year time horizon, figuring out how we continue to provide these benefits that have been promised to people. So this is important. I'm trying to skip a lot of the quantitative aspects, but have you take away the big picture when we talk about asset allocation analysis, some things to consider, and how standard deviation and volatility tie into that. But any questions on this? Okay, so where does that leave us? Page 18, what do we believe? Well, sources of risk are the primary driver. Back to, okay, yeah, equity risk is our biggest risk in the portfolio, so why don't we just avoid it? Well, we need it, right? And because it is the primary driver. But balance is critical. We can't achieve our other objective of diversification and being prudent without balance. We're not putting all these assets into, what we expect to be the highest return category. Balance is also appropriate between having a sense of urgency if certain things happen. We can't ignore it. We need to understand it, and maybe we should react, but maybe we shouldn't. And those are where the most difficult decisions are, but also the most important decisions are. And that's, so balance is important. I don't believe longer term investing is a set it and forget it. We can't, whatever people said in 1980 at the beginning of those charts, even if it was a 60-40 mix, and even that worked out well, that's not our role as fiduciaries to just kind of set a long-term strategic allocation and forget about it. We should challenge that, question that, and understand how that evolves. And I'm not going to go through each of these points about asset allocation and specifically the ranges, but the ranges are important to have a point in time, which we don't, a policy, a specific exact percentage down to the basis point, to the 0.01%. A lot of other plans do that. We differ from plans there. That's just way too precise, right? So we have ranges that enforce these things that we believe in terms of diversification and are geared towards helping us achieve our objective. I'm going to skip over page 19 because I've already talked about some of those liquidity needs from the standpoint of why we're focused on it. And so that takes us to page 20, what happened here? Page,
We go from
Sorry.
19 to 23.
yeah.
21 and 22 are confidential.
They're in the fifth dimension. And so,
What are you putting past us?
Jack, I could put nothing past you, so not making any effort to do that. My apologies for the page, but the next page is at the top, proposed asset allocation option 1. And as noted on the left-hand side, this is what was approved last year at this time. So this is the status quo, right? Option 1 is keeping it the way it is today, the status quo. And it's important, on the left-hand side is really the allocation between STIP and CAP. And that is driven by this liquidity, right? How much do we think we need over the next several months? And we want to make sure that's in STIP such that if we have events like October, we're not fully invested in equities or fixed account. Equities are liquid. We could sell any of our equities tomorrow. But if we were forced to sell those today instead of selling them last month, we've put ourselves in a difficult position, right? We want to sell equities when it's more advantageous to us and not be forced. So that's why we have a small allocation in ranges for STIP and the majority of it being in CAP. So option 1 here is the status quo. Option 2 is actually what I would recommend, and so I'll talk about the changes there. On the left-hand side, there's no changes in the allocations between STIP and CAP. I think that's good. The liquidity isn't really changing, so recommending we keep that the same. The CAP allocation on the right-hand side, from a high level, if again you think of the 60-40 portfolio, equity, fixed income, not looking to change that meaningfully, not going to touch any of the equity ranges. So as we look at the top here, domestic, international, private equity, natural resources, real estate, those ranges, not recommending any changes there. The ranges as currently stated today give us plenty of flexibility to move within those ranges if needed to achieve the goals. But as we go down, and you'll see in yellow here, changing a few of these numbers, and so they're highlighted in yellow. So the tips, for example, the low end of the range recommended from 2 and high of 6. This is from the current range of 0 to 4, so moving the range up 2%. Similarly, for U.S. Treasuries agencies, it's currently 5 to 14%, recommending 6 to 15. High yield from 1 to 5, recommending increasing from 2 to 6. And then cash, similar, incremental, but the other way. It's currently 1 to 6, going to 0 to 5. The reason for that cash decrease is because we now have this stable STIP allocation outside the pool liquidity. And we don't want to be forced to hold 1% in CAP if we have enough liquidity outside of CAP and STIP. We want to be able to go down to 0 cash in STIP if we think, that's the best thing for us to do kind of near a term. That's really to increase the flexibility there, why lowering the range of cash. The other 3 areas recommending incremental increases are all fixed income. And that's being driven partly because interest rates are rising. That seems to be the expectation. They are now, those are tighter ranges than the equities. And so if interest rates continue to rise, even if it's gradually, they should play a bigger role in our portfolio because they will help us reduce risk, but they'll also have a greater impact if interest rates continue to rise over time on achieving that actual return. So let me stop there. Option 2 is what I would recommend. I view it as very incremental, and but continuing down this path to probably reduce the actual allocation within the domestic equity pool, it will still be well within the ranges. Right now, we're closer to the high end. And over time, putting in some of these other asset classes within their ranges, and that's another reason why some of these fixed income classes, I think in the current state of the world, should increase. But let me take questions.
So the changes seem to be slight. And so do you anticipate, so from what I just heard you say, you anticipate transferring from equity to fixed income basically, but does that mean you're going to be, is the change necessary? Because otherwise you're talking about bumping up against the high range on each one of these.
Actually, in most cases right now, so tips for an example, as of today, we have 3.9% of the cap pool in tips. So as interest rates have moved up over the last few months, and as those inflation expectations have stayed low, we've moved a little bit more into the portfolio in there. So we're right at the top of the range of tips today. That's why we're increasing that range, and why we're increasing not just the high end, but also the bottom end. I think tips as an asset class are something strategically that should be in our portfolio. So we are, by making these slight modifications, we still have, with the exception of tips, the other three have still a fair amount of room between their actual allocation and the top end of the range. And the reason for the incremental change, well, why only move up 1% or 2%? The reason is to date, our move in interest rates going up has been pretty incremental. It seems significant within the small scope of things, but it's been incremental, and so we have an incremental reaction to that. If 5 years from now, we look back and interest rates are 300-400 basis points higher, not our expectation today, but at that time or between now and then, we will be coming back and asking for probably higher allocations, because if we can achieve returns closer to the actual return only in fixed income, we should lean a little bit more in that direction, because it would tighten that distribution closer to around that actual return we're achieving. We're very far from that today. The only way we have a chance of achieving those actual returns today is maintaining our being equity heavy. But that's why we look at this once a year, and that's why most years this will be an incremental. It won't be a significant move.
Other, that's my question.
Mark, Jim, comments?
Is this a fundamental change in the structure of the portfolio? No. Is it going to require, if you adopt it, assets to be sold and other assets to be bought? No. Is it increasing to a very modest degree the amount of flexibility that you're giving your staff to make changes within those ranges in the future? Yes, a little bit. Other than that, that pretty much sums it up in our view, and we're supportive of it.
What increases the flexibility to make changes to increase the amount of fixed income, right?
Those particular ones that Joe has outlined in yellow are
Right.
expansions in the range, yes.
Right.
And they are in those categories.
And that, do you think, is prudent at this point?
I think it is consistent. First of all, it's incremental. Second of all, it's consistent with the delegation of authority that you've had to your staff for the last 10 years. Let me put our consultant hat on and say we work for the board, not for the staff. I will say that every time that you expand flexibility in your delegated authority, it expands incrementally your sort of challenge and obligation to monitor its execution.
Right, but the question is that what it does is it increases the flexibility such that staff can buy more, we'll have a greater percentage in fixed income.
If
And
it's
is that-
exercised in that direction,
Right.
Joe indicated that depending on the path of valuation for the asset classes, there may be an opportunity to actually shrink down the substantial overweight to domestic equity and place it in more defensive categories if it seemed warranted. That's the delegation model that you had with your staff.
And you think that's prudent?
I think it is prudent. As I say, RVK is supportive.
Yeah, I would just say, I mean, these are, to Jim's point and Joe's point, I mean, these are relatively small incremental changes. It's not, your objectives and your investment objectives in terms of return and risk and your constraints, mainly in terms of liquidity, haven't changed that much. I think there's reasonable rationale presented as to a slight expansion of the parameters here. And yeah, I mean, it doesn't seem out of bounds of imprudent.
So one thing on the flexibility, because I was thinking about this, the ranges are not changing in size. That would be one definition of flexibility, to take a range and just make it bigger both ways.
Right.
In the cases recommended the change here, the range size is staying the same, they're moving up. So the flexibility here is at some point in the future to potentially take risk off the table. Right? And so yes, that is ultimately the flexibility that trying to embed and ask the board for here is to, in an incremental way, be mindful of the risks we have, be mindful of the risks that have really helped us, but also manage those risks as we go forward and have some flexibility to decrease the risks in the portfolio in terms of the equity fixed income.
One more question. And I noticed that you, except for tips, you moved it up one slot, the minimum and the maximum. Why did you move the minimum up?
For exactly that reason. I didn't want to just, increase, say, oh, we should have more flexibility, make the range huge. I wanted to keep the constraints about the same and have this be more about the overall risk of the portfolio, have the flexibility change, as opposed to day, not having any of these ranges just be wider.
Okay, I got it. I guess we need a motion for that.
That would be great.
I would entertain that.
So
Second.
And the motion is to approve option.
option two.
Wait, who moved it, who seconded,
Do
sorry?
we have a second?
I second.
Take
I didn't second it. Is there further discussion on that? All right, all in favor say aye.
Aye.
Opposed, no? That was-
That's it. Thank you.
And so I look, and I see that 21 is after 23. I didn't notice that before, but it actually does exist. 21 and 22 do exist.
And then we have another 23.
And then we go back to 23 again, so.
Some things I can work on.
You might be here for the duration.
All the important things in life you're supposed to learn in kindergarten. I still can learn more.
All right, anything else, Joe?
No, that's all.
So, recap of our to-do list.
To-do list, I have a rough sketch of a letter response to be made here, if you care to take a look at it. We will look at the SMI versus 176203 and want to reply to the board. I believe Doug gave everybody the Neptune and Consumer Direct allocations yesterday. We will add the experience level of senior management with new managers to the briefing sheets. Anything I'm missing?
My birthday present, or Christmas.
We got you a beautiful
It was bunches of flowers, but we decided to do
So on that letter, I just looked at the draft too, but anybody, I assume, who wants to look at it, Wayne can do, Dan's got the draft. Anything else? All right, we're adjourned.
Good meeting.
Pretty good.
a lot of stuff this month.
I don't need to